Good morning, ladies and gentlemen. It is Wednesday, March 6th, 8:45 a.m. And this is one of those days. It's one of those days where you've got to wake up and be excited that you are invested in one of the most interesting companies on the planet. Ladies and gentlemen, even though we touched it briefly and we're just below it right now, we're actually right at the dot. 20 freaking 6 for Palantir is here. $26. We are at $25.97 in the pre-markets. We were just at $26.05. We got the screenshot at 26. So now we are at $26. We're going to see if this 26 is able to last for the day. But so far, I think we got to start off the morning by ringing the bell a little early. Palantir up 9% right now in the pre-markets. Now, you may be wondering, why is it up right now? As teacher Ian says, ring the bell. We had to ring the bell. Why is it up right now in the pre-markets? We're at 26. We're like hovering on that $25, $99, $26 range. We won the Titan contract. And we won the Titan contract in fierce competition against Raytheon. And it looks like this Titan contract, which is $1.5 billion over 5 years, we got $178 million. Yesterday on my Daily Palantir show, we did the analysis from William Blair that said Palantir is likely to win the $178 million deal. Today, they officially announced we won the deal. Now, William Blair, Louis De Palma, who's been historically bearish on Palantir, he put out that note yesterday, basically trying to make a bearish argument that even if we get that deal, it's not going to matter because it's not going to increase top-line revenue. I don't know what he like. I don't know any. He in the note he was like, "Oh, AI is not having a significant impact on their business." Like, I don't know what. At some point, your ideology has to overcome the real facts, and the real facts are that Palantir is above $26 in the pre-market because this deal is massive. This deal is substantial. $178 million over 2 years is just a small part of the overall $1.5 billion deal. This deal is to make 10 different prototypes for the Army. And Palantir has succeeded in proving to the Army against Raytheon that they are the ones to be able to get this deal, and they're the ones that are deserving of this deal. Here we go. Palantir announces that the Army Contracting Command Aberdeen Proving Ground has awarded Palantir, a wholly owned subsidiary of Palantir Technologies, their USG division, a prime agreement for the development and delivery of the Tactical Intelligence and Targeting Access Node, or Titan ground station system. The agreement, valued at $178.4 million, covers the development of 10 Titan prototypes, including the 5 advanced and 5 basic variants, as well as the integration of new critical technologies and the transition to fielding. One day, we are going to be developing 100 to 150 of those Titan prototypes. My boy Adam, he'll be on the channel on Saturday. He originally introduced a lot of people to what this Titan contract is, and we'll be talking about it more this weekend. But it seems like this $178 million that's going to cover 10 prototypes, that $1.5 billion is eventually going to cover 100 different prototypes. And that is why we got the deal this morning. This is something that the street cannot ignore for 2 reasons. Number one, we beat Raytheon. We were competing against Raytheon. Both Raytheon and Palantir got $36 million to develop the first prototype in June 2022. We have officially beat Raytheon for this contract. The street cannot ignore that. That is a very, very big deal. Number two, this is the first time a software company is becoming a prime contract for the hardware contract. Remember in the little bit of the PR that I just read, this is a prime contract. And that means, for those that don't know what like being a software prime is, it's something Shyam Sankar has been talking about for the past 2 years, that if Palantir can become the US government's first software prime, we have about 5 to 6 hardware primes, Lockheed Martin and Raytheon are 2 of them. If we become the first software prime, well, whenever the U.S. government needs to procure software, which is every single year, especially given the geopolitical crisis that's going on, Palantir will be the prime contractor, the first name that we call up, which just means cha-ching, 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 cha-ching for Palantir in the context of these government deals. And that's why the street has the stock at $26.06 right now, up 9.49%, $26.07 in the pre-markets today. This is exciting stuff. But that's not all. That's not all. On top of that, we got another piece of news today in the pre-markets on Palantir. We got another piece of news, and this other piece of news that is also just so juicy and exciting, and they're kind of cascading all these deals on top of each other. AIPCon 3 is happening tomorrow. I'll say that again. AIPCon 3, the conference where we show off AIP and how we're using it, is happening tomorrow. I'll be streaming it live at 10 a.m. Or 2 p.m. Or 2 p.m. Eastern Standard Time. So it'll be 11 a.m. Pacific. It'll be live on the channel. Here we go. Here's the core things Palantir said in this press release about what AIPCon is. First of all, in the title, Palantir to unveil new customers at oversubscribed AIPCon. You know who told the PR team to put the word oversubscribed in the title? I think it was Alex Karp, because we know on the earnings call, Karp has been saying this is the most in-demand event. All these companies and executives are trying to get in, and Palantir has to be so selective. I'm pretty sure Karp told the PR team before they put, this is oversubscribed. This is like a startup that people are trying to get into. Like there's billions of dollars chasing a deal. Like this is oversubscribed. There are more people that want to attend this conference then there's even room inside of the conference hall to be able to take all those people. 60 customers are going to showcase their work at the AIPCon, unveiling 20 new customers and partners. So 60 customers will be showing their work. 20 new customers and partners will be unveiled officially for the first time. This will be happening tomorrow, March 7th. Palantir introduced the AIPCon in mid-2023, and that year later they introduced AIP bootcamps. They have officially launched. We finally have a number on this. Some people were estimating 500. Some people were estimating 600. 850 AIP bootcamps have happened across the United States, in Detroit, Chicago, New York City, Washington, D.C. We know in this month we're doing Zurich in Switzerland for AIP bootcamp. And next month, we found this from LinkedIn because the Palantir community is insane and we stock everything. Next month, we're doing London. These are going to be insurance-based bootcamps on how to implement enterprise AI in Zurich and London. And we know in December with Accenture, we had a AIPCon in India. So when we talk about scale, this is massive, massive scale happening at unprecedented levels when it comes to Palantir's AIPCon. And it's pretty damn exciting because it's like, if this is happening, we will have, as we guessed last week, we will have our Nvidia moment. It's not now. It's not next quarter. It may not even be in 2024. It may be early 2025. But at some point, giving all this software away for free, getting all these clients onto pilots, getting them situated towards what the software could look like, and ultimately getting them into the deal, that will indeed result in a massive blowout quarter that the street, I think, is finally starting to realize, hey, we got to buy this stock, because at one point they're going to be the S&P 500. At one point they're going to deliver a crazy quarter. At one point we can't just think Karp is just talking to talk, that he's actually saying stuff that's real, and what he's saying is like actually happening. Maybe we need to buy the stock. And as a result of that, I think that's why we're seeing the momentum in the context of Palantir. But that's not all, folks. Here's the list of the customers that are going to be at AIPCon. Okay. Lennar, General Mills, Lowe's, Cone Health, CSX, OpenAI, Kaz Investments, Partstown, 8VC, and many others. Now, one of those names is not like the others. And I might have had a little bit of inflection in my voice. The intonation of my voice might have went up a little bit on one of those names that I just named. You can maybe guess that my inflection went a little higher when I read and when I saw this morning, just like everybody else. Maybe you're finding about it for the first time. I woke up at 7 a.m. I saw this and I was like, holy crap. Open freaking AI is a customer of Palantir. OpenAI is going to be presenting, either they're going to be on the main stage or they're going to be presenting their own AIP bootcamp. We don't know officially, but if they're on the main stage and a representative from OpenAI is saying, hey, yeah, we're the premier $80 billion, AI company that's out there in the world, and we're the one, Sam Altman, making all the big names and everything, but we're using AIP because even we need to implement the security and the governance and the infrastructure that Palantir creates, which is why it's not really a competitor with OpenAI. Palantir's not making an LLM. LLMs are a commodity. Like Anthropic is a competitor. LLMs need to be organized in your organization in a way that makes them useful. And maybe OpenAI, it seems like they're going to say AIP is actually helping us implement our LLMs for different enterprises. Talk about just like insanity in terms of the level of partnerships we would have and how it would ultimately operate. So it seems like there's going to be AIP's obviously, or OpenAI is either going to be a customer or a partner, a way to be able to help implement AIP. Either they're using AIP. There's going to be some partnership discussed with OpenAI tomorrow that we're going to see in terms of how AIP is having an impact on their business. It's going to be really, really, really exciting stuff. And it seems like the street, at least today, up 9% right now in the pre-market, is starting to recognize maybe they need to take Palantir a little seriously when it comes to what they're doing. Palantir right now, 25.96. We were just at $26. 26 is going to be psychological resistance. In my opinion, it's going to be tough to break through. We've broken through in the pre-market. There's going to be a lot of sell side pressure. A lot of people that bought at 16, 22 that were in it for a swing trade, they're going to get out of it at 26. The good thing about being long-term is that it really doesn't matter. You know, one day I believe the stock is going to probably be worth 200, 250 bucks. So 26, 25, 24, 23, it's not a big deal. The question is today, can we actually break through that psychological resistance? And can we get through that psychological resistance in a sophisticated and a meaningful way? So it's going to be exciting to see what this looks like at the market open in about 30 minutes. And again, Lowe's Health, Cones Health, CAS Investments, Partstown, 8VC. There's going to be all these different customers and partners that are going to be introducing how they conceptualize AIP, whether they use it, whether they integrate it for other companies. Obviously, OpenAI, it's going to be interesting to see what this all looks like. Let's get CNBC's update on it and what they thought as soon as this news broke this morning.
Morning, good morning. Good morning. It's good to be here on set with you guys. Well, this is a high-profile win for Palantir. The defense tech startup awarded the U.S. Army's Titan program. This was picked over an industry stalwart, RTX, marking the first time a software company becomes a prime contractor of a big hardware program. Titan, or Tactical Intelligence Targeting Access Node. This is a mobile ground station that accesses data from terrestrial and space sensors. It uses AI to help provide more precise targeting for long-range precision strikes and battlefield planning. Palantir, as Palantir puts it, it's deploying the Army's, quote, first AI-defined vehicle. First contract, $178 million to develop and deliver 10 prototypes, working with subcontractors that include Northrop Grumman, L3Harris, and startup Anduril Industries. It's not the biggest ticket program, but it is significant. The engineering and manufacturing development phase estimated to be about $400 million. Now, this is big for Palantir, though. This represents the company's fourth largest contract by annual revenue run rate. That's per a recent William Blair note. And it boosts the government portfolio as growth in Palantir's U.S. commercial business has been surging. Also reflects the role that AI will and already increasingly is playing on the battlefield. And as you can see right there, shares of Palantir moving higher right now in the pre-market, up about 3%.
All right, for the layperson, dropping an AI box like this on the battlefield means what? You can see where the enemy's moving, or it can predict where the enemy's going to move?
Yeah, so all of that. So it's this whole idea of long-range precision targeting data. So basically being able to pull data from space sensors and terrestrial, air, land, take all that data, basically boil it down, run it through AI models, essentially, I'm assuming, and then be able to take that and have a more precise locator for whatever it is you're looking on the battlefield that's not within plain sight, that's further away.
Big deal.
Yeah.
Or just use a nuke and get rid of everything.
But don't you want the most precise information and targeting data before?
I'm cynical about how scary everything is, and hypersonic weapons that I guess we don't have, and Putin's talking about a nuke on a satellite, and it just. I mean,
it is a very from that perspective that you can have a more surgical.
You need to have. We need to cover all our bases.
This is going to be a big contract, folks. This is going to be a big contract. And the reason this is going to be a big contract is because the Army needs stuff like this. The reason the Army needs stuff like this is because the geopolitical crisis that we're currently in is leading the Army, the military, to recognize that, hey, it's not enough for us to just, kind of compete in the current landscape that we're in. We need to be able to do this at a astronomical rate. And that means we're going to have to spend billions of dollars here. And Palantir, as a result of that, is going to be a beneficiary. 25.97 right now in the pre-market. Look at what happened. Look at what happened yesterday. So Louis De Palma, we all know he's been incredibly bearish on Palantir. William Blair, analyst. I think, I mean, I hate to say it publicly, but the guy is a public analyst about Palantir. I think this guy has lost all credibility. And I don't want to be mean here, but yesterday he put out a note that says Palantir is likely winning a $178 million Titan contract. The reason he said he put out this note, and, these analysts have access to all this insider information. I don't even know how this, how you can put this out before everyone knows. But the reason he put this out is to say, this is what he said. And this last night when I read this, I just couldn't believe this. Ultimately, AI has not made a profound impact on Palantir's consolidated revenue trajectory. LOL. Even when adding this $89 million per year, the Titan contract to 2024 revenue, the total is still below analyst projections when the stock was trading 67% lower, despite robust demand environments on both commercial and defense sides of the business. This is why you cannot trust these analysts. He says, oh, this is only going to increase their guidance to 2.65 to 2.67 billion, short of consensus expectations of 2.8 billion. Two things here. Number one, first of all, Mr. Louis De Palma, you are putting the expectation of 2.8 billion. If you just listen to what Palantir said on their earnings, their expectation is 2.6 to 2.67 billion. So you can say that the guidance revenue expectation is 2.8, but you're living in your own little world. Palantir, the company, has not said that. These analysts are trying to basically say that this deal is not a big deal because it's still not going to increase their revenue. They're not looking at the qualitative aspects and the long-term implications of this deal. And second of all, they're coming up with these arbitrary numbers, just like he did in Q2 2023. He said, oh, Palantir is going to do 555 million in revenue. And Palantir is like, no, we guided for 533. What the hell are you talking? Why are you trying to up-layer the expectations and then we're going to miss, even though we never said that we were going to get to those expectations, just so you could then say that Palantir, can't deliver, which is absolutely insane. These are what these analysts do, and it's why you have to be very selective when you read this stuff, because I believe personally they have some political agendas here that are motivating this stuff, because there's no other way you put out this nonsense. Second of all, he says, ultimately, AI has not made a profound impact on Palantir's consolidated revenue trajectory. Again, I don't know what the guy is smoking. The company's growing 70% year over year in the United States on the backs of not Foundry, not Apollo, AIP. The artificial intelligence platform is creating this scale. 850 boot camps. What software company, someone please tell me, on the entire planet has conducted almost 1,000 in-person, I wouldn't even call it sales sessions, product-led demos, and it's much more powerful than a demo, that ends up converting into a sales meeting, because people are just like, holy crap, I actually get to use this. And by the way, I can take this away for the next 6 months and use it for free if I wanted. And I got to learn how to do this in 6-7 hours versus 6-7 months. And then that ends up leading to potential customers. We are seeing an influx of demand at an unprecedented level. This is what it feels like to be on the cutting edge ground floor of a tech company that is scaling. And for you all, including myself, to be an investor in one of those tech companies. I've never invested in a tech company at ground floor. I mean, look, we were all here at $6, even at $50 billion. I feel this is, the first floor of an elevator that's going to start to go up much higher, because it seems like Palantir is aggressively executing against what they said they were going to do. And in technology, I mean, this stuff scales. This stuff really, really, really scales. Mike Archelangelo says customer count is going to fly this year, which will make 2025 at some point our Nvda moment. I 1000% agree. If you look at a company like Facebook, the reason I bring them up, if you go to the App Store, Facebook is number 4 in the top most downloaded apps in the United States in the iOS App Store. Facebook has 4 billion users. I don't understand how they are finding more and more people to download their app. Like at some point, who doesn't have a Facebook account on the planet? I know there's, other billions of other people that may not have access to the internet, but somehow Facebook is finding a way to get billions and billions and billions more users every single year. And they're already at 4 billion. They're already at almost half the population on planet Earth. I bring that up to say technology scales at an unprecedented level. Whether it's a consumer app or an enterprise platform, the beauty of building technology platforms, the beauty of building a software company is that it's infinite scale. You will never have all 8 billion people on your app. You will never have every single enterprise in the world, which means you can keep going for thousands of commercial clients, thousands of governmental clients, thousands of all these different entities that need something like a Palantir. What is Palantir selling? They're selling understanding your data. That's what they're selling at its very core. And so if every organization in the world needs to be able to make sense of their data, and to make sense of their data in a particular way that actually drives business results, not just something that the C-suite can say on an earnings call, oh, we implemented this analytics software, so now we know what we're doing. It's like, no. Is that analytics software actually increasing revenue and decreasing costs, and as a result, increasing operating margins to allow us to buy your stock? Because if it's not, then it's worthless. And Karp has been saying for a very long time, that is what we're trying to sell. We're trying to sell software that actually works. And eventually the street's going to recognize that. And it seems like today up 8%, 8.9% right now in the pre-market, the street has started to recognize this. Here we go. This is another post from Ether Square that I want to show you guys. If you are not following him, I'll put this tweet in the chat. Everyone should definitely be following this account. Ether Square right here posted this a week ago. He finds different Foundry links on the internet. So if you type in bp.palantir.foundry, you're going to find some links from different companies that are on pilots with Palantir software. They have a custom company link, and then it's like followed by a .palantir.foundry link. In Q1, this was posted at the end of February, he has found 200 links already of new entities that haven't existed before. That doesn't mean they're clients. That doesn't mean they're customers. That just means they are piloting Palantir software. And we have more than enough historical evidence to know that if they have a .palantir.foundry link, they are definitely working with Palantir, because we've seen plenty of them actually turn into clients in the coming weeks. This is how crazy the Palantir community is that we actually track this stuff. Q1 still has another month, March left to go. We might have a quarter. We added 47 customers last quarter. We might have a quarter where we're going to add close to 50 to 70 customers, dare I say 100 customers. Now, look, I don't think that's going to happen. I think that's being optimistic. But the fact that we have those in the pipeline in one quarter, we're going to be able to convert all these guys into paying customers. This is going to be exciting. This is going to be really, really exciting. There was a Tesla one ages ago, correct? Yes, there was a Tesla.Palantir Foundry link that doesn't exist anymore. Maybe they took it down and they're still working together, but they didn't want to make it public. The point is, Palantir is one of the most exciting companies in the world. Let me read this quick tweet, and then we'll finally move on from this news and get to everything else we got on the market open. If you're new here to the stream, I do a market open every day. Thank you for all joining. And every single day we go live talking about the markets. And today, Palantir is, we talk about Palantir every day, but today, Palantir is really taking up the news. And so we're spending some more time discussing what's going on with them. Here's what I tweeted this morning, and I genuinely believe this, and I think everybody that's here in the chat will agree. Palantir is the most exciting company in the world, and so much of the world still does not know about them. I mean, Palantir compared to Tesla is like 1/1000th of the media coverage. We're lucky we got a CNBC clip this morning, right? Like, it's very hard to get coverage for Palantir. It's our little $50 billion secret that one day will be worth much, much more than $50 billion. And I know a lot of people in the chat got to invest in this bad boy when it was only 20 to 25 billion. And eventually we'll all just be sitting back watching the world talk about how this company became massive, knowing we were all here together on days like today, all 2,300 of us, obsessed with every detail of new contracts, many of which we already knew because of how insane all of us are in this community, how obsessed we are with understanding this investment thesis. But it'll be incredible to see the world finally get to figure out what we've known since $6. When Wall Street did not have Alex Karp's back, retail, the stock, the shares we were buying at $6, $7, $8, $9, we had his back when Wall Street didn't, which is why Wall Street has to buy our fucking shares at $25.82 because we were buying them at $6. Wall Street didn't care, and now Wall Street has to pay up a ton of money for these shares. And the funny thing is, most of us are like, $25.82 ain't enough. We're not selling this bad boy until we see triple digits. This is what happens when you actually do due diligence on a company and get in early and understand what the fuck is going on before the rest of the world actually wakes up. All the memes, all the jokes, all the finding random lines from finding articles to get massive DD, it all adds up to days like this where Palantir lands a massive contract and beats a legacy defense company like Raytheon for a $178 million deal. And again, beating Raytheon, given their influence, is just not easy to do it. I think this is the best community on the internet to have days like this. And as Karp says, we've got to keep attacking. This is awesome. This is awesome, 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 awesome. And it's super, super cool to see this happening. So congrats to everybody. Now, I'll say this is the last thing I'll say on this, and then we'll finally move on to some other stuff going on in the markets. We're up 8% right now. The one thing I do want to be cautious of for people is that I don't know if we're going to be able to maintain this. Being up 8% is awesome. Palantir is a stock that tends to get sold off at these higher levels. We did make a 52-week high in the pre-markets. I think there's two scenarios in which in terms of what happens when the market opens. Either we blast through this $26 level and it's just aggressive. We go through 26, like it's mean, like earnings the day after earnings, we just blasted through $21 and we never looked back. Literally, we have never seen $21 since earnings. Or, you know, we kind of take a fall back down to this early 25, high 24, 90 area because there's a lot of sell side pressure. We're going to see. So far, it looks like we're going to blast through 25, and it looks like 26 is very possible, just given that we're not selling off massively in the pre-market as we're up, and we're hovering around that 9% range. But I think anything is possible, and we just have to be prepared to see what ends up happening when the market opens. But it's going to be exciting. It's going to be exciting to see what happens. Sachin says, outside earnings move, Palantir daily move max outs at 11 to 12% in extreme green days. That is correct. And so far, we are up 9% The last time we had a higher than 12% green day was post earnings, where we were up 20%. That's the last time we had a really high volatility day to the upside. So usually it's 11 to 12% to the downside or the upside. And again, Palantir has consolidated phenomenally well from 23 to 25, even 22. We touched 22 for like a day, and then we got back to 23. The consolidation phase, I said back in February, like 9th after earnings, I said, look, let's give it 5 to 6 weeks to see if we're even in the clear or if this is all just a mirage and we're going back down below 20 to the 17s and 19s. I think with this contract and the way the street's reacting, I just think below 20 is going to be really hard unless something macro economic happens. We'll be streaming the Jerome Powell Congress thing today. So I'll be at 10 a.m. We'll be streaming his testimony to Congress. The CNBC just put out an article about what he's going to say in his testimony. And he basically is saying the same thing he's been saying for the past 3 weeks, which is that we have to look at data. We're not going to cut rates anytime soon. We still think 3 rate cuts will happen this year, but it's not happening in May or it's not happening in March. And so that's it. So I don't think Jerome Powell can say anything that aggressive to tank this market, which means the question becomes, is the street finally going to realize that these types of military contracts are important and they're going to end up buying up the stock to get us above this 9% that we are right now? And we'll see in 19 minutes what it looks like for Palantir. So it'll be exciting. It'll be very, 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 very exciting. It'll be cool, dude. And it's so fun to celebrate this with the entire community, dude. It's so cool. All of us have been in here for so long. We've been covering this company for so long. I think in a couple months, it'll be 3 years for me. And it's just fun, dude. It's really 26 right now in the pre-market. There we go. It's just fun. It's fun because the other thing about this is, why did they say oversubscribed AIPCon? Is Snowflake saying that they're oversubscribed? Is like a Salesforce saying they're oversubscribed? I know Salesforce is a much bigger company, but the point is, Palantir is a small $50 billion software company that only has 497 clients. So Salesforce can afford, massive arenas in San Francisco and invite 50,000 people. Snowflake, much more smaller scale. But is the excitement, is the energy, is the sort of this feels like an AWS Microsoft conference, right? This kind of feels like WWDC in the context of AI, because Palantir right now is the premier AI play. WWDC, Apple's, core conference. It feels like the energy is there. And the reason I think they said, hey, this is oversubscribed, is because they want to let investors and the broader community know we have something the world wants. And when you have something the world wants, you have something that is a beautiful thing that I'm sure a lot of people in the chat, a lot of people who are investors here, a lot of people who have conducted business deals throughout the majority of their life, you have something called leverage. And when you have leverage, that means you have influence in terms of how the world is reacting to your product. And leverage and influence is one of the hardest things to build. And it either takes incredible levels of grit and personality, or it takes incredible level of product. In the context of Palantir as a company, it takes both. You need to have a phenomenal product and you need to have a real unique persona that gets people excited about that company. I mean, look, it's B2B enterprise software, dude. It shouldn't be exciting. It's not Tesla. It's not Apple. It's not, it's not Instagram. It's a B2B enterprise software company. And for some reason, a large chunk of the world, at least the retail world, has been excited about this company for 3 years. And now Wall Street is finally waking up that maybe we should be excited as well. 25.95, up 9% in the pre-market. Snowflake has collapsed since their earnings. They're down about 30%. They're up 1% on the day. I think the divergence we're seeing with Snowflake and Palantir looks like it's going to pass Snowflake's market cap for the first time since they went public. Palantir will probably be worth around 57, 58 billion when the market opens. Snowflake's going to be worth about 56 billion. And the reason that's happening is because the Snowflake CEO retired. He is now the chairman of the board. The street did not like that. And Snowflake lowered their guidance expectations to 22% year-over-year growth. Now, even if they're sandbagging, Palantir only guided for 20%, which Palantir is also sandbagging. So let's say they both are sandbagging and they both end up with 25% year-over-year growth. Palantir and Snowflake are then growing the same. The argument that Snowflake's this massive growth monster, Palantir can't grow, that argument doesn't hold up anymore. That argument does not hold up anymore. So really, really exciting day. Awesome stuff for Palantir investors. We'll see if this can end up holding up. But thank you all for being here with me, and congratulations. $25.88 in the pre-market. And the fun thing about being long is that you don't have to worry about selling. You kind of just like, all right, let's see. I'll wake up in 10 years and see what happens with this company as they continue to execute. All right, awesome stuff. So that was the Palantir coverage. And we'll move on to some other stuff we got in the market open today. So for those who only joined for Palantir, thank you for joining. And we'll be talking about it more throughout the entire stream, but we're going to move on to some other stuff. We got the market open in 15 minutes, and let's see what else is going on in the broader market. One of the things that's going on is, of course, Bitcoin continuing its rally after falling pretty aggressively yesterday. By the way, Shyam Sankar will be on CNBC at 4 p.m. today, so we'll be live streaming that and seeing what he has to say about this conference. Right here, Bitcoin, $66,755, up 3.2% right now. It fell from 69 to 59 yesterday, rebounded up to 66. That's also why the entire market is up. MicroStrategy is up 7.2%. Palo Alto Networks up 2.3%. By the way, CrowdStrike, if anyone has CrowdStrike, congratulations to you. CrowdStrike is up 23%. Now, look, do they deserve to be up 23%? They had a good earnings. Do they deserve 23%? I don't know. But if you're a CrowdStrike shareholder, you should be pretty thankful you're up 23%. They just crushed on their earnings. 23% level of crush? Probably not, in my opinion. But still, the street likes it. They're a premier brand in cybersecurity. And so this is what happens when you invest in good companies. If they just somewhat execute, the street's like, all right, well, we don't know where else to put our money, so we're going to put our money here. And they end up getting the bulk of the investor base that's excited about that space. Nvda, $880. It's up 2.39% in the pre-markets. What's seeming like a AI revolution is starting to become built on the backs of not only the stock, but this company. Again, Nvidia, $2.15 trillion, third largest company in the world. This is another reason why Palantir is up $26 in the pre-market, up 9.32%. It's because the market has recognized that GPU demand is going nowhere. If GPU demand is going nowhere, by the way, Nvidia didn't even have China revenue back in Q1 or Q4 because the US government banned them from selling chips to China. So when they introduce China revenue coming in over the next couple quarters, those expectations are going to be even more massively. So you've got right now Nvidia here at $880, up 2.4%. Third order derivative plays like the Palantirs of the world, like the Snowflakes, the Datadogs, they will benefit from Nvidia's GPU demand. The question is going to be how much. And I think out of the pack of those derivative plays, Palantir is going to be, I just think, the number one company in there. So that's going to be really exciting to see what happens in the video right now at 880. Robinhood up 16.17. They had a nasty dip yesterday, about 6% down to 15.74. Right now they're up 1.5%. IBIT, Bitcoin Trust up 8%. Let's talk about some stats in regards to Bitcoin. We have some pretty monster stats that occurred last night in regards to what's happening with Bitcoin. So the BlackRock ETF for Bitcoin, IBIT, they brought in $788 million yesterday. $11 billion in management, assets under management when it comes to Bitcoin. So sorry if there's a little delay, guys. Let me just get rid of a couple of tabs, make sure that you guys should easily be able to see that. Okay. We should be good. Okay, so $788 million. $788 million here on the Bitcoin ETF. Yeah, sorry for freezing, guys. It should be good now. That is a lot of money for the Bitcoin ETF. I mean, that's not a small amount of money. On top of that, they got $788 million, but also ARK Innovation or ARK-B, they got $63 million yesterday, and Fidelity brought in $125 million. Now, the reason we saw some outflows yesterday is because there were some wallets for Bitcoin that mined Bitcoin in 2010. And in 2010, those wallets ended up selling yesterday. So there were some wallets that mined Bitcoin for probably like 10 cents. They ended up taking their gains. All right, you can't blame them, right? So there was some sell side pressure yesterday, which is why Bitcoin ended up falling from 69 to 59. But it was a flash crash because Bitcoin immediately got right back up to that 62, 63 range. And now we're trying to push 67,000 right now here before the market opens, which has been pretty intense. Now, the reason we had the other reason there was some selling is because there were some outflows from GBTC. So GBTC had $332 million in outflows, but net on the day. So even with the $332 million in outflows, Bitcoin ETFs pulled in $662 million for their ETFs. I mean, just gigantic numbers that are gargantuan in terms of the fastest ETF launch we've ever seen. And as a result of that, you've had Bitcoin basically do a rebound. So for those that wanted to get in or wanted to, take advantage of that dip, there were some companies. I took advantage of the dip yesterday. I ended up, adding a little bit more to my position. But it seems like that was a dip that was something that the market kind of expected in regards to what was going to happen with Bitcoin, since this tends to happen more often than not, especially in 2020. We saw that before Bitcoin got to all-time highs, it went up, it went right down, it went up 20%, went down 11%, and then proceeded to go on all-time highs. Here's a chart I want to show that's incredibly interesting that I saw last night about the impact of the Bitcoin halving. So for those that don't know what the Bitcoin halving is, this is when the supply of Bitcoin goes from 1.8% of inflation per year, the United States currently inflating at about 3% in terms of our currency, to 0.9%. So it breaks in half. It's kind of built into the programmatic nature of Bitcoin, which is why investors are also so excited about it, because it introduces and reinforces and underscores the level of scarcity within this asset, which in a world in where we print $7 trillion in 2 years, scarcity is one of those things that kind of is a thesis to invest in something, because if there is demand and there's not enough supply, basic economics says that something should increase in value. So here we go. The first halving in November 2012. After the 365 days after the halving, the asset went up 8,000%. In 2016, the second halving, 365 days after the halving, the asset went up 284%. In 2020, the third halving, it only happens every 4 years. 365 days after the halving, the asset went up 538%. If this continues, we are expecting at least a double on Bitcoin, about 150% gains after the fourth halving, if history continues to repeat itself in regards to what happens. And the reason it runs up this dramatically is because the supply decreases. So if the supply decreases and more demand chases it, obviously the asset tends to go up. Now, the only difference here is that now there are institutional buyers interested in Bitcoin. 2605 right now on Palantir, and the pre-market's up 9.4%. It's not just a retail-driven phenomena. There's actually ETFs. There's actually companies that have tons and tons of money that are willing to allocate to Bitcoin. As you know, if Apple took 0.5% of their $200 billion cash and dumped it into the ETFs and had some exposure to Bitcoin, that would be enormous for inflows, even if it would not be, anything to Apple, and it would give them a way to diversify their exposure. So that's another reason why it's incredibly important for Bitcoin this time around to have the institutional legitimacy that it has. Ethereum at 3,800 right now. It touched 3,900 this morning. And that's also making the market a little bit more excited about what this asset can do after this halving. So it's going to be really, really interesting to see how this ends up playing out. But that's what we got in the context of Bitcoin. And that's why the street is excited as well. Let me play this clip. This is a smaller clip, but we do need to play it. So Elon Musk has sued OpenAI. He has sued OpenAI in the context of them not being open. Elon Musk originally funded the company with $50 million to be a competitor to Google, or like a hedge against Google having a monopoly on AI. It seems like now Google just has a monopoly on like hating white people or something. So I had to do. I'm sorry, Google. I had to do. I had to say the joke. Apparently, OpenAI put out a report yesterday with some pretty damning emails. Some of the most biggest Elon fans today tweeted that they've lost respect for Elon. Apparently, Elon told them in 2016, you guys are going to have to become profitable because there's no way you guys could actually compete with Google if you don't raise money and like turn into a for-profit. And that's why a lot of people are like, well, why is he suing them if he basically agrees with what they're doing? Here we go.
The executive edge, OpenAI has publicly responded to a lawsuit brought by co-founder Elon Musk. It reproduced some old emails from Musk in which the Tesla CEO encouraged the startup to raise at least $1 billion in funding and agreed that it should start being less open and, in his words, not share the company's science with the public. In one email from 2018, Musk wrote that OpenAI had no chance of becoming a relevant competitor to Google's DeepMind without some meaningful changes. Those emails are at odds with Musk's lawsuit filing last week, in which he accused the company and CEO Sam Altman of deviating from its initial mission by keeping inner workings of its AI model a secret for commercial purposes. In response to OpenAI's blog posts, Musk posted on X, "Change your name," reflecting his criticism that OpenAI is no longer an open source project for the.
So that was his response. I love Elon, but I bought 20 shares of Tesla this week, so I am not an Elon hater. I'm an Elon supporter. I'm trying to, I'm trying to build my own empire. I'm trying to be an entrepreneur. So Elon is a motivation beyond imagination. But that just wasn't a good response. That just was not a good response. This is the actual email. Let me show you guys this. OpenAI put this out last night, and it was pretty intense. So this is what Elon says back on December 26, 2018. My probability assessment of OpenAI being relevant to DeepMind Google without a dramatic change in execution and resources is 0%. Not 1%. I wish it were otherwise. Even raising several hundred million won't be enough. This needs billions per year immediately or forget it. Unfortunately, humanity's future is in the hands of, and he probably wrote Sergey or Larry Brin in the redacted part of the email. So when they go to court and OpenAI is like, okay, so Elon's suing us for becoming profitable. But then in 2018, he basically said, if you guys don't raise billions of dollars, which who's going to give you billions of dollars? There's no nonprofit committee. The world is run by human nature. Microsoft, that thinks that you guys can make them billions of dollars, was the company to ultimately invest about $13 billion into OpenAI. They're basically following Elon's instructions from 5 years ago. And now Elon's basically saying, hey, you guys should have never went open. And also in these emails, Elon says that open sourcing your technology will actually give you a disadvantage, which obviously if you open source stuff, then the whole world can use it. So he also says you have to keep some stuff proprietary, which means you have to keep it closed. So you've got Elon basically admitting you got to keep some stuff closed and you got to raise a crap ton of money. The only way you do that is if you become profitable. So now it's kind of confusing, kind of where Tesla and where Elon on this lawsuit is ultimately going to end up. Look, I'm a big Tesla fan. I've been buying the Tesla dip. I bought it at 187, bought it at 180. It's at 179 right now. I might buy a little bit more today, but this is not the best news for Tesla. I mean, at the end of the day, investors are just like, why is he trying to sue this company? Like, why is he doing all this and that? He's tweeting like crazy, and I don't even blame the guy for tweeting. He has his own free speech. He wants to do what he wants to do. That's on him, but investors are definitely not loving it. Tesla right now, 179. Let's look at Mag 7. Apple's had a rough day. Apple was 169 last night. It's 171 in the pre-markets. Again, the entire market is up. Oh, I forgot to say, why is the market up? Well, yeah, it's not just Palantir getting a deal. Palantir 26 on the dot in the pre-market. We got job data, guys. And this job data was pretty damn good, which is why the market is up right now. So here's the job data we got. And that's why Apple and Google are actually up a little bit in the pre-markets. Private businesses in the United States hired 140,000 workers in February 2024, following an upwardly revised 111,000 in January, but slightly below forecast of 150,000. Now, you may be saying, okay, the market expected 150,000 jobs. We're only getting 140,000 jobs. A myth. Why is that good news? Well, in this unique economic environment that we're living in, we actually don't want that many workers because the U.S. government at least the Fed, not the government, is trying to not like dramatically increase the unemployment rate, but they want to increase it a little bit. It's at 3.7. This is one of the tightest labor markets we've had really in the history of the labor market. And if more people have jobs, there's just going to be a harder chance to decrease inflation. It's not like it's going to be impossible to decrease inflation, but it will be harder. So the fact that we actually came in below expectations, 10,000 jobs, which isn't a lot, but it's kind of perceptually to the markets like, okay, so labor market's not as tight as we thought it was. Unemployment will rise just slightly, not enough to cause a massive recession, but just slightly, which means inflation should cool down. And this right here is the Goldilocks zone in regards to the broader economic environment. We got 2 minutes until the market opens, and then we'll see what happens, especially with Palantir as we open. What's really unique about this situation is that we printed $7 trillion a couple years ago. Then inflation surged to 10%, the highest it's ever been in 40 years. Then we raised interest rates, the highest and the fastest we've ever raised them in 40 years. And now we've kind of beaten inflation up. I mean, shelter is still there, oil is still there. OPEC is doing some production cuts, and that's not the best for oil prices, which will not be the best for energy inflation. But inflation's at about 3.1%. CPI next week might show a 2 handle on inflation, 2.9 headline CPI. If that's the case, the Fed cannot keep interest rates high for this long. And not to mention, we're paying almost $1 trillion of debt a year on the national debt because interest rates are this high. So if inflation's coming down, unemployment's not going up, and the Fed, and it's an election year, right? So the Fed also, we know what happens in the election year. We're going to have a scenario where in July or June, we will likely have rates come down. Even if it's not a lot, we will have rates come down to an extent. And when rates come down, it like the economy, the market's already doing pretty phenomenal. And the economy is doing good. Every company put out their earnings. Target, Lowe's, Macy's, all these retailers, they've just crushed on earnings. Home Depot, Costco will be reporting this week. If earnings are going good, inflation's coming down, and rates are coming down, we might have a pretty damn good year. And then you've got Nvda that's just is showing that there is a new industrial revolution, and the 2 letters that it starts with are A and I. And so we've got a lot of stuff going on in this market. It's pretty exciting to see how it plays out. And now we just have to see how the market ends up turning over the next couple of months. Once we get all this new data, and once we have companies continue to execute on Q1 earnings, Q2 and Q3 as we get later into the year. So it's going to be really, really exciting to see how this plays out. Bitcoin, 66,855. Ethereum, 3,837. All eyes on Palantir in 18 seconds. We are going to see how the market reacts at 25.84. Does the market go up? Does the market sell off? And where this is going to go. Ladies and gentlemen, thank you all for being with me here today. This is the best community on the planet for the stock market for Palantir. 9:30 a.m. from the bottom of my heart means the absolute world. You guys are here with me today. Wednesday, March 6th, the stock market is now open. Wake your ass up. If you're new to the stream, we ring the bell every morning at 3:30 a.m. It's there, not 3:30 a.m., 9:30 a.m. If we did it at 3:30 a.m., that would be even more interesting to start our days. Here we go. Let's analyze the markets. Palantir, 25.85, up 8.5%. So as soon as we open, we get a little bit of a sell-off from that 26 level. You can see there's a little green candle turning into a red candle right there. Still up 7%. You can't complain too much. The question now is going to be how much sell-side pressure is actually there, and how did that sell-side pressure ultimately affect what's going to happen with Palantir? I'm going to open up my order book flow. I don't have the most perfect book flow, but I can at least take a look at what the sell-side pressure looks like. The next wall for Palantir, it doesn't seem like it's still 27, guys. At 26, like there's not a lot of shares at 25.5, 25.9. There's not like there's 200,000 shares waiting to be sold at 25.90. It seems pretty clear, at least on my side. Now my data is not perfect, but from what I'm seeing, if there's enough buy side pressure that comes in, volume already 18 million, and there's just a little bit more buyers than sellers, this thing should crack 26. We got to see. It's going to be hard to do it, especially because there's people that want to take their profits at this level. And 26 is a big psychological level of resistance. We know the market makers are not always excited to give us those milestones. But let's see. It's a big contract we got today, and now we got to get to see if we can actually move up 7%. Inbound in the chat says, is this move justified or not? I think this move is justified. 25.94. Let's see if we can get to that $26 level. This move is justified because to me, it sets a precedent for future contracts. And if those future contracts are big, then it just means that the stock is currently cheap right now if you're pricing in that growth. Palantir right now at a $56 billion market cap. Snowflake is at a $55.9 billion market cap. We finally have beat Snowflake ever since going public. By the way, Snowflake since going public, negative 23% return. Palantir since going public, 200% return. It's pretty incredible. Palantir was beloved by retail when no one loved Palantir. Snowflake was beloved by Wall Street when everyone loved Snowflake. And the divergence and the product difference and the moat and how Alex Karp's leadership has, turned Palantir into this monster. It seems like that is reflected 2 years after going public if you bought Snowflake or you bought Palantir. So Palantir right now at this 25.70 range, I think we can crack 26. There is not resistance from the sell side pressure in terms of walls that are there that are just like massive walls. Like you need 700,000 shares just to pass 25.90. There's just more sellers than buyers right now. And that's why the stock's not cracking through 26. So we'll see if that can actually, go higher as we get into the market and as it begins to open up a little bit later in the day. Let's see some other stocks. Bitcoin crossing 67,000, 67,240. MicroStrategy's up 13%. Berkshire, 403 up 0.6%. SoFi, this took a nasty beating yesterday. It fell 16%. I did buy some SoFi. I bought 100 shares and I bought a ton of leaps for the $20 2026 range. $7.32 up about 1% on the day. Fortinet, cybersecurity play. This is up 1.95%. Snowflake up 1%. Palantir 7.5%. Robinhood up 0.5%. $16. SMCI, oh my goodness, 3.9% up on the day. $1,100 for SMCI. Nvda is just not stopping. $879. PE of now about 70. So it's getting up there, but I don't think you can say it's necessarily grossly overvalued given the growth rate that is occurring on Nvidia. And it seems like investors, if they want to allocate capital somewhere, they're picking companies like Nvidia that is putting up the numbers. 877. Dell is up 2%. They had a pretty good earnings. Their transition to servers for these GPUs is making them kind of a big AI play. HPE up 4%. They're working with Dell as well in the same space around those servers. GBTC is up 8.55%. Grayscale Bitcoin Trust. Coinbase, oh my goodness, 8.3%. They are up as well. 234. Their IPO price is 250 that we haven't seen in about 3 years. CleanSpark, 1628. They're up 6%. IBIT, BlackRock's ETF, is up 8.5%. Target crushed earnings yesterday, continues to go up 2%. It was up 11% yesterday. S&P 500, 510. They took about a 1% fall yesterday. Now they're up about 0.67%. Celsius, congrats to those that have this energy drink company. They're up almost 25% from their earnings, 86.92. Arc Innovation, 49.97. They're up 2%. Beyond Meat, up 1.6%. SoundHound, AI play, up 5.4%, up about 120% year to date, fell about 30% over the past week just because it got a little bit too high. AMD is at 212. That one's up 3%. It seems like investors are saying, all right, if we didn't get into Nvidia, we're getting into AMD. So that's kind of the play that's going on there. PayPal's up a little bit. Enphase, 127. Amazon, 175. Monster, that's at 58. Google, 133. They're up today, even though they're down pretty badly from a couple of weeks ago. And then we have Uber at 79.67, up 0.73%. Palantir, 25.26. All right, so it's selling off a bit, getting a little bit of a red candle here. Look, it makes sense. People are taking their profits, and we kind of thought that people would take their profits. So it is what it is. But the fact that we were able to blast through that level, and look, we have a long day to go. It's only been 5 minutes, so we'll see what happens. Average volume usually during this time is about 5 million. Right now, we're at 25 million, so we're 5x that volume. Palantir has liquidity. This stock absolutely has liquidity. So now the question simply becomes, can it capitalize on that liquidity by having more buyers than sellers? And that is what's going to get this price to go up 6.7% on the day. For those that are just joining, we got the Titan contract, $178 million deal. Palantir is officially secured. It's a 2-year deal, $89 million a year. This is their 4th largest annual contract by revenue run rate. So it's a very, very big deal. And the market is starting to recognize why it is such a big deal for the Titan contract. On top of that, for those that are just joining, AIPCon is officially starting tomorrow, AIPCon 3. 20 new partners and customers will be on this conference tomorrow. I'll be streaming it live on my YouTube channel here. 850 boot camps have been completed. OpenAI will be presenting. Lowe's will be presenting. A lot of big companies will be here. And this event was oversubscribed. It was very, very difficult for people to get access to this event. But this event is indeed happening, and it'll be live tomorrow. So it's going to be exciting to see what happens. Palantir 3030. Adam, thank you. Buy a share on me. Palantir to the moon. Thank you for the $26. We're going to have to buy a share on Adam here in the public fund. I do have a public fund where we just buy Palantir whenever we get super chats or anything like that. So whenever you send a super chat, which you don't have to do, thank you so much for just being here on the stream. It just means the absolute world to me that we get to celebrate this together. But when we do get a super chat, we buy some freaking Palantir. So let's deposit some of this into the public fund. Into the public fund right now. So here we go, $26. Let's deposit that here. We got $500 the other day. We're like, all right, we're buying Palantir at 23.30. It was a good dip. We got to buy some Palantir. Let's buy 1 share of Palantir on Adam. Here we go. You guys can see this, right? Yep. Buy. Let's do 1 share on Adam. Thank you for this, man. Best community in the world. Here we go. 25.50. Let's buy it. Submit order. 25.41. Not bad. Another share in the public fund for Palantir. Now we have about 168 shares here. 168 shares here in the public fund. All right, there we go. All right, Tesla. Let's talk about Tesla. What's going on in the world of Tesla? So Tesla's had a rough day. Palantir right now 25.46. Tesla 178. It is continuing to get crushed here. The other big thing about Tesla, and the reason why they're actually down, it's not because of the OpenAI stuff, even though that stuff's not good. Tesla margins in China are down. Tesla has had a couple of dramatic price cuts in China. BYD is selling electric vehicles for $15,000. So a lot of these Chinese consumers, which by the way, China's 25% of Tesla's overall revenue, they're like, why should we pay, 30, 40, 50,000 for Tesla when we only have to pay 16,000 for BYD? And BYD is a Chinese brand. There's a little bit more cultural sort of assimilation that goes on there. So that's what you've got on Tesla, 178. I've been buying the dip. I don't know if I'm stupid for buying the dip on Tesla and their Q1 earnings that they did not give any guidance on margins or volume on. They're going to shit the bed again like they did in Q4, and that the dip will actually be 165. But I've been buying the dip, and we'll see if it goes from here. And my thesis on Tesla is the bot. I know a lot of people might not like hearing that, but I think Optimus is going to produce billions and billions and billions of dollars of net income, not just revenue. So a big believer in the robotics thesis on Tesla, and I'm buying for the long term. But we'll see how it plays out. Right now, Tesla here at 178. Can I see the public fund anywhere? So I mean, it's on my public.com account. It's not really like a public fund you can access, but I tweet about it all the time. So if you follow me on Twitter, you can see like updates on the public fund pretty much every week. So Twitter is in the chat. Please make sure you check that out and you'll be able to see it there. Okay. Now SoFi, what did SoFi do yesterday? SoFi basically said, we are going to raise $750 million in convertible debt. And what we're going to do with that $750 million until 2029, we're not going to have to pay it back. We're going to take the initial $750 million and pay back our pre-existing debt that's at a higher interest rate. It was a very strategic, smart thing to do for SoFi. The reason they're down 16%, this bad boy was at almost $10, $9.15 the other day, is because the street has interpreted that as dilution. It's not necessarily dilution because the stock price has to be 130% above the listing price, which is probably around $8, in order for that dilution to occur in common stock in 2029. If SoFi is not above $7.50 or $8 by 2029, the entire thesis has failed, and it's just not an investment that worked out. I don't think that's going to be the case. So to me, this dip is really juicy. Do I like the fact that they're doing this convertible debt? Not really, but do I think it's smart? Yeah. And so it's a growing company, a profitable company that has to do stuff like this. To me, it makes sense. And at 7:30, they are now below where they were before their Q4 earnings. To me, that's just stupid. And if that's just stupid, then I think we should get. I think it's worth a dip opportunity, even if it's just a swing trade to $10, $12. I don't think that it deserves to be at the 735 level. But one thing to understand is that Wall Street hates this stock. Wall Street is filled with banks. SoFi is a bank, and because Wall Street really doesn't care about SoFi being successful, and they have an 18% short float, which is probably just going to be people doubling down after this report, you're probably going to see a little bit more volatility in the context of SoFi. Sachin says, I have bought heavy in SoFi today and tomorrow because dilution will kick in later. We can exit near $9 or $9.50 with reasonable probability. Now we'll take those odds. Yeah. So even if you're like Sachin that just wants to get out at $9.50, a trade at 7:30, in my opinion, is not the craziest idea because I don't fully understand SoFi as deeply as other people, but I understand it enough to say that it's not supposed to be worth $7.33, especially because this thing wants to break out. The volume on SoFi yesterday was 180 million. Today it's 20 million. SoFi, you could argue, is even more liquid than Palantir in terms of how much liquidity they have and volume on their stock. So there's definitely liquidity there. The question is just, can it continue to execute to get above these levels? For those that are just joining, saying, why is Palantir up? We have received a $178 million Titan contract. That Titan contract as well is incredibly important because it means that, we are probably going to get a lot more from Titan in the future. Titan is a $1.5 billion contract. We got about 200 million in this phase. Palantir clarified today in the press release that this is one phase of the contract. There will be many, many more phases, which means, dude, there's a lot of fucking money coming to Palantir. It's just that simple. And that's why the street has it up right now. $25.90 on Palantir. Let's see if we can crack through that $26 level as well. Here's a clip I want to play from my friend Adam. I'm going to put his Twitter in the chat. He has been covering Palantir for a very long time. And one of the core things about Adam is that he studies the government business very, very well. This is a 4-minute clip from my daily Palantir show yesterday. He introduced me to really understanding Titan back in December. So I'm going to let him talk and give you some coverage on what is Titan, why we should win this deal, and why this is so important. Here's Adam for 4 minutes. I'll put his Twitter in the chat. Here's him talking about what's going on with Titan.
So let's get into Titan, because I want to give an update to people on that. Titan is a $1.5 billion contract over 5 years that you have publicly said on our last stream that if Palantir doesn't get it, something's really wrong. They announced back in November that it's not going to be announced at the end of 2023, which we all expected, even though they said it would. It's going to happen in 2024. What are your updated thoughts on that contract, Palantir competing with Raytheon, Palantir's collaboration with Anduril, and how likely we are to get the contract?
100%. If I had to put my money down right now, that's how confident I am. With Shyam mentioning on the earnings call, Titan
by the way, Adam was right. He said he had 100% confidence. He was right as per the news today.
By name. He mentioned Northrop by name. And for those that don't follow me, I put it out there about a week ago. There is 2 variations of Titan. There is an advanced variation, which is Northrop that will be involved. And then there's the basic variation, which is Palantir, Anduril, and I'm sure Northrop as well. So the reason why I think it's pretty much, I don't want to say locked, because there always can be a change, is the mention of Northrop and Titan by name on the earnings call. They have given Titan updates along the way this year, and there has been no update from Raytheon. I looked at Raytheon's Q3 earnings call, no mention. I saw 0 update of it. I am going to assume that the reason why this was delayed is they were causing a bitch fit, and they said to them, that's not fair, and like Carpus said to us,
ladies and gentlemen, we are above $26 today and 12 cents. Let's go. I will go back to this clip in 1 second. Again, Adam was being kind of prophetic there. We beat Raytheon for the deal, and Adam was like, yeah, Raytheon's they're not getting this deal. And today, the day we got the deal and we beat Raytheon. I'm going to go back to him in a second, but here's the chart. Palantir right now, 26.24. Oh my God, we're up 10%. Breakout has happened. The breakout has happened. Here we freaking go. This is what it feels like to be on the ground floor of a tech company that's just starting to take over the freaking world. $26.05. Look, we might dip under. We might go back to 25. But the fact that we even broke out, the fact that we actually broke out from this $26 level, and maybe, just maybe, we retain this 26 for the rest of the day, is pretty exciting. When I looked at the order flow, there was no walls. So the only reason Palantir would fall from 26 is because of more sellers, not because there's these artificial walls that are out there, basically like trying to hold down the stock. So if we fall, it's not because of anything else other than the fact that there's more sellers than buyers. There's not that much sell side pressure that's waiting for Palantir on the opposite side. And so right here, you got 26.15. 26.15. There's not a lot of, let me pull it up right now just to make sure how much of the sell side pressure is there. Okay, so there is a wall. Now there is a wall. The wall is at, the wall just got formed on my chart. I'm looking at it. Okay, so until we get to $27.20, we are in the clear. But at $27.20, let me just show you guys this right here. You see this right here? There are 370,000 shares at $27.20. You guys can see that right there on the screen. If you can't see it, all right. There's 370,000 shares if you can't see it. But yeah, so until 27.20, which I would be okay with 27.20. That would be okay with me. We have someone who needs to buy 370,000 shares. Until we get there, we've got a fun ride to potentially get up to those levels. If you were short Palantir, as Arny says in the chat, you're screwed. You're screwed. If you were short Palantir, you're screwed today, up 9%. And you either got to close the short, which is going to cause a little bit more of a squeeze. By the way, there's not that big of a short float. It's only like 5%. People are more afraid of shorting Palantir than I am of texting my girlfriend 5 minutes late. I mean, Palantir is a stock that is just not heavily shorted, unlike SoFi that's up, short float 18%. Some of these Celsius, some of these other companies are heavily shorted. Palantir is not. And then on top of that, if you had covered calls at 26, 26.5, yeah. Look, if you had covered calls at 26, here's what I'll say. You are probably looking like this right now. If you had covered calls at 26, you're not screwed, but because we don't know if it holds 26, but if you had covered calls at 26, you are looking like this right now. I'm sorry. You're looking like this. You're probably looking like this. You're probably looking like this. If you got some covered calls, you're not the most excited right now. So that's what we got on Palantir. We'll go back to the update. Let me get you guys back to what Adam was saying about the Titan contract. Here we go.
Go. Give them 6 months. Give them a year. They will not build what we will build. And I think that is what's happening. Just if I had
and just to speak on that real quick, that is, I think, the best part of investing in a company like Palantir, because everyone, that ticker symbol U video came out that said, he doesn't have a pricing strategy and they don't know how to. And my thing is, like, I want to invest in technology companies that can massively grow, and to massively grow, you've got to have products that are absolutely cutting edge, generational, which means the CEO theoretically shouldn't give a shit about you paying for it. If he knows it's so good, you're going to pay for it. And that really matters in the government space, because they don't want to pay for anything for many years until they finally have to. And when they have to, let me underscore that point. Palantir is a company that believes that their product is so good that you shouldn't have to pay for it until you actually use the product enough where you're willing to pay for it. And in the government space, they don't want to pay for anything. So the fact that Palantir is willing to build this stuff for free and let them use it and then get the fruits of their labor, it just goes to show you this is not a company that's trying to sell you on anything. They're trying to show you that they build shit that works and then they make money. And that's the company that we are investing in. Falling right now at 25.96, so falling right below that $26 range for Palantir. Then you get a lot of revenue.
Right. And we saw when they released the Vantage information, they saved them over $3 billion.
Yep.
That's why they got the extra 10. They got 3 from there, and they said print 7 in the back. So that is why it's so big and it takes time. So with SOCOM, if you saw, I posted that YouTube video about 3 weeks ago of the platform that I think they built with Palantir. SOCOM, they got $400 million contract from SOCOM like in June, and the day or two before that, I literally tweeted about SOCOM saying they're gonna get a ton of money from SOCOM, and the day after 400, they can get $1 billion from SOCOM next year. It's not out of the equation. Everyone needs to wake up. $886 billion. Palantir is going to get a fair share of that. That's
886 is the defense budget, and SOCOM, for those people that don't know, is the United States Special Operations Command.
It's just the Department of Defense. That doesn't include the Department of Health, the Department of Homeland Security. It is enormous, the amount of pie that Karp is talking about. So with Titan, that is why it is an absolute must win for them. If they do not win Titan, they're not going to get all the little, call it indirect revenue streams that would have come from Titan. So
do you think they could split it with Raytheon? Or
before they made that article about one vendor, I said I wouldn't be surprised if they wound up splitting it. Now, absolutely not. It looks like it's sole vendor, one company plus Northrop, because Northrop is developing the space one.
Adam was so right on this, dude. We beat Raytheon. We beat Raytheon for this. And so we thought we would split it. We didn't end up splitting it. We actually won the entire deal. We just have some subcontractors that we're giving parts of the deal to,
which is the advanced portion. And this goes back to why I said space is the most important part for them, because it's all connected from from space. So when they win Titan, the avalanche of money is going to catapult them to another echelon. It might not happen in fiscal year 24. It might not happen till mid 25. But you have to understand that Titan is going to bring so much money to them, because it's going to allow them so many avenues to sell to the Department of Defense. So with Titan, they're going to be connected to thousands of weapon systems and vehicles and soldiers. So it's just going to create so much more, quote unquote, usage for Palantir. And you were the first one that dug it up in the 10Q. They made a 10-year, $2 billion compute deal. Why? Because they know they're going to be using a shit ton of more compute power over the next decade. I wouldn't be surprised if we see that get increased in value next quarter. Because if Palantir, let's just use the three main platforms, Gotham, Apollo, and Foundry. Let's just use those. If those three platforms are going to be increased usage, let's just go by 30% in the next, they're going to have to spend. And that means those people are spending with Palantir to use the platform.
There we go. So that's Adam's argument on why Titan is going to be big and why there's a lot of money in the defense space that's eventually going to come potentially to Palantir. Again, they have to try to win those deals. It's going to take time. It might not happen this year, but Titan is just one example of these contracts. Palantir is selling off a little bit. The broader market is selling off, so I wouldn't read too much into Palantir selling off right now. Snowflake down 1.2%, Tesla down 2%. I mean, look, we're up 6% of the day. So I know we want to be greedy here, but I just want to continue to underscore to every investor listening and watching, the stock is up more than 50% now year to date. I mean, let's look at it year to date. Palantir currently, I believe year to date is up 50.1%. So, I mean, we can't get too greedy saying, oh, we're not at 26. Like, it would be awesome to get to 26, but you know, the way the stock market works is that there's a give and take. There's a push and pull. So, you know, we might get sold off. We might reach it a little bit later. It's only been 20 minutes as the market opened. We'll see what happens. But the fact that we're even up 7% on this news, the fact that we would get a contract like this, we got the Army Vantage deal in December 2022. I remember making a video on it, $116 million. The stock went down. It went from like 850 to 760 that day. I remember that day like it was yesterday. Those were the traumatic days that we dealt with as Palantir shareholders, seeing the best possible contracts you could imagine every single day, and or at least every other week, and the stock just not reacting. Sentiment has changed. The narrative has changed. This is a whole, in the words of Atticus Huxley, this is a brave new world that we're in. And this brave new world has Palantir at $25, up 6% of the day, not back at $7 or $8. We got Jerome Powell speaking in about in how long? In 7 minutes. Let me make sure this is happening at 10 a.m. I believe because Jerome Powell is speaking. Yeah. So this thing is happening at 10 a.m. He's going to be speaking in front of Congress. What I think the market is also a little bit afraid of, guys, is that Jerome Powell is going to say some nonsense, which he's going to say the same stuff he's been saying. The Elizabeth Warrens of the world are going to be like, so how does money work? And he's going to be like, well, Mrs. Warren, there is something called inflation. And so like, there's going to be all that back and forth happening. But I don't think it's enough to get, the market to fall off. But maybe the market's a little scared right now that Jerome Powell's going to say something. And that's why we're going to see some downside momentum. And that's why things are selling off. Bitcoin, 66,000, Palantir, 2538, Snowflake down 1%, Tesla, 177. Getting back to that 175 range right now in Tesla. Robinhood 1594, SMCI up 2%, 1115. Nvda 880 up 2% on the day. QQQ 439. NEO's up about 6%. CleanSpark's up 5%. IBIT up 7.82% on the day. Someone says no, he didn't. He didn't just quote Huxley. I'm a man of elegance. Okay, it's not like my 8th grade teacher forced me to read Brave New World. By the way, I haven't read it since 8th grade, but the book was so profound and I barely remember the plot, but it was so profound. I really need to spend a day like either listening to the audiobook or something. It is an incredible book. Brave New World is just absolutely like, I don't even fully remember what it's about, but it stood out to me because it was like 1984, right? It's one of those books. So we are in a brave new world when it comes to Palantir. D-Fin says, who cares where Palantir ends up today? The Titan news was great. I agree. I mean, like we should not, honestly, if the stock falls down, most longs should be okay with that because the Titan news was great. The company is executing. This is what I said after Q4 earnings. Whether the stock went up or down, now we had a monster move, but I think all of us, me, Arny, Vince, everyone who was on that call was like, holy crap, these numbers are good. For once, the numbers are matching what Karp's arrogance is implying. And I say that, in a very nice way. Karp's very egotistical, arrogant about his company, his vision. That's because he fucking believes in it. He's a founder CEO. He's not just a suit that's running Palantir. And he's been talking the talk for a long time, but the stock hasn't really walked the talk. And finally, the numbers, not just the GAAP profitability, but the 70% growth in US, the 40% guidance in US, the 93 million in net income, the 3.7 billion in cash, the adjusted operating income margins going from 29 to 34%, doubling in the past 18 months from 17% in Q3 2022. The numbers actually solidified his cockiness about Palantir. And so this Titan contract is another thing solidifying that. If the stock falls, whatever, the company's executing. And that's the only thing we can ask for in the long term. The stock will eventually will reflect that. So we'll see what happens. We will see what ends up happening. Amit, can we do a book club with your viewers? Yes, of course. We will definitely do a book club. Karp's new book, Technological Republic, that'll be out, I think later this year, like May or June. The fact that a CEO of a public company is releasing a book, dude, come on, bro. Come on. The CEO of a public company is releasing a book. He's that excited and entertained by what's going on in the markets that he's willing to put out a book and to talk about his philosophies and his ideas. Like, what other CEO is putting out a book? Elon's not writing a book. He has someone else write out a book for him. Alex's Karp is like writing a whole book about his philosophy around technology and Silicon Valley and Western values. I mean, that to me in and of itself is exciting to invest in a company and a CEO who has the sort of intellectual stimulus to actually put out his thoughts and ideas like that. And, we'll see how it reflects on Palantir. But it's really, really exciting what Palantir is doing. 2024 seems like it's going to be their year. Stocks reflecting their progress. And now, as long as their numbers continue to point to the right direction, we will see some good stuff happening. Here's one clip we have until Jerome Powell talks. Shyam Sankar was on a recent podcast with not Jerome Powell. Shyam Sankar was on a podcast with Jerome Powell. He was on a podcast with Jason Calacanis talking about what's going on in Palantir and the defense space. I'll play a small clip from that. Jason Calacanis, obviously the host of the All In podcast, really big VC dude. And so we'll play a little bit of that until we got Jerome Powell talking, and then we'll see what Jerome Powell has to say. So here's Shyam talking about defense technology. Today we land a big defense contract for Palantir.
Perceive Palantir, right? At the beginning, I guess with a little bit of Peter Thiel's iconoclastic, image and Silicon Valley's, peacenik, beatnik cultural heritage being the summer of love here, the anti-Vietnam movement, all this kind of led to maybe Silicon Valley not being super interested in supporting the government, specifically supporting the military. How has working at Palantir changed over the last 2 decades?
It's changed tremendously. If you go all the way back to, when I joined in early 2006, there wasn't even quite this sense in which we shouldn't be doing government work. I'd say it was mostly people were disinterested in it. And certainly investors thought there was no business to be built here. So it was very hard to actually raise capital. And if you fast forward a little bit, I think we started getting into the era where it was politically quite distasteful. Working with the government became more quote unquote evil. And that was kind of a different era. And then, of course, things have changed quite a bit now, I think, particularly precipitated by the invasion of Ukraine by Russia. People kind of realize that there are bad actors in the world, that freedom is not assured, that history did not actually end with the fall of the Soviet Union. And in many ways, I think it's a reversion to the mean. It's where the valley came from. It's more authentically what the industrial base used to look like at the dawn of World War II. At the beginning of World War II, there was no defense industrial base. There was just an American industrial base. We really turned to automotive companies, electronic companies to build the arsenal of democracy that ended up actually winning that war. And the early Cold War, Chrysler had a missile division. And General Mills, the cereal company, used to make inertial guidance systems for ICBMs. They made equipment in artillery. They had a mechanical division.
Wow.
And so
I
think
know that.
this present moment where we have pure defense companies, that's the aberration. The much more normal thing is you have an industrial base that makes things, some of which provide for national security and some of which provide for American prosperity.
Hey, when your business gets to a certain size, the cracks start to emerge. We know that. It's all that stress from your amazing.
All right. So that is Shyam Sankar. You could just Google that podcast. You'll find it. Shyam Sankar, Jason, This Week in Startups. And he's talking about Palantir's origins and why Silicon Valley is finally starting to get excited for defense tech companies. Anduril is a subcontractor in this Titan contract that Palantir got today as well, which is going to be incredibly important because obviously Anduril is a really hot startup in Silicon Valley. The fact that Anduril is, raising money and they're getting all these big clients, it means that the defense part of Silicon Valley is now thinking of defense as a legitimate class to be able to fund with billions of dollars. I think defense tech startups raised about $34 billion last year, and that means more and more companies are going to be aiming for government contracts. That's not just competition for Palantir, that's expanding the market for Palantir because that means the government obviously is in demand, is looking for all these defense tech companies, which is the only reason why VCs are even funding those defense tech startups in the first place. And so that's going to be really exciting. Palantir with their FedStart product, that's going to be creating a platform for all these companies that want to sell into the government because you need accreditation, you need confidentiality, you need the right resources. And so Palantir is going to find a lot of ways to not only monetize the government, but monetize all these little startups that are raising billions of dollars that want to sell to the government, because you're probably going to have to go through one of the three companies that has IO level 6 security clearance. Microsoft, a couple trillion. Amazon, a couple trillion. Palantir, 54 billion. I think we're early. I think we're pretty early. Okay, we got Jerome Powell soon. It's going to be starting at 10 a.m. Right now, it's 10:01. Until that starts, we'll look at the market. 25.18 on Palantir right now, falling just a little bit, but still up about 5% on the day. Sachin in the chat says, Anduril is the world's only pure play integrated hardware software company, like Tesla was first hardware software integration for the car. Yeah, Palantir is more software, not hardware. Anduril is a little bit of both. And so it's really exciting to see Anduril be working with Palantir as well on these deals. And it's probably something that we need in the 21st century when it comes to defense tech and where defense tech ultimately is going to go. So really exciting to see how that's happening as well. Anduril is the name of Aragorn's sword in Lord of the Rings. Well, Palantir alumni founded Anduril. So that's why you're seeing this whole kind of Lord of the Rings synergy between Palantir and Anduril. That's why they're working together on these contracts, because Palantir alum founded Anduril. So that's why they're working together. So that's why it's super exciting to see how they're operating and what they're trying to get done together. Jerome Powell should be live soon. We have him here. The stream didn't start, but once it starts, I will be going to it. Probably should be starting in a couple minutes. Until then, we'll look at what else is going on. Bitcoin falling a little bit, 65,000 right now. CrowdStrike 345, that's up 16%. MicroStrategy up 10% on the day. Matterport is up 1.6%. QQQ up 438. Nvda 878. SMCI 1119. Robin at 1589. That's falling off a little bit. Coinbase 230 up 6%. CleanSpark 1547. CleanSpark's been up and down 10, 15% pretty much every day over the past couple of weeks. It is up 150% from its lows in January, so that is good for CleanSpark, but they are becoming pretty volatile as well. Pishes says, my friend works at Anduril. He's offering me secondary shares. I'll be buying as much as I can. Congrats, dude. That's amazing. Getting those Anduril shares on the private market is not easy. It's not easy to get access to that startup. So, look, I don't know if they're going to become a huge public company, but if I were to bet on a startup and take a risk, I would definitely be interested in Anduril. Very exciting stuff to see what Anduril is doing. IWM small caps not breaking out, but they're above 200, which is really good. They've stayed above 200 for the past couple of days, which is nice to see. Google continuing to have problems I guess with culture or with execution, Google started to fire some people from the trust and safety staff. So they're starting to get rid of what some people would call the wokeness that is in their AI biased Gemini product that they've had to kind of shut down over the past couple of days in terms of image generation. They are down another 1% today. Again, market taking a little bit of a reversal. I wouldn't suspect that if Jerome Powell just speaks nicely, the market shoots right back up in an hour or two. I think that could absolutely happen today. But the market, Palantir now falling below $25. The market's definitely scared of what Jerome Powell is going to say, and that's getting the markets to be a little weary of what's going to happen as well. Also, let me make one quick announcement for those that are here today. This is actually, it's cool that Palantir got this contract today. Tomorrow at 10 a.m. on this live stream, I am launching a new software that I've been building for Palantir at 10 a.m. I'll be giving an entire presentation on it. It's something I've been working on for 5 months. It's a culmination of the, I guess, thousands of videos I made, millions of words I put into writing articles and tweets about Palantir. And I think it's going to be one of those products, if you're a Palantir investor, I think you're going to want to have. It's $42.69. We have to charge for it because it does cost money to be able to run the product. I think it's really cheap, dude. I think $40 a year to access this product and have unlimited use cases of it. I think most Palantir investors here would be willing to pay $40. I tried to make it as cheap as I could. I have never, monetized the audience. I don't have a Patreon. I don't have a Discord. I don't have a paid course. This is one of those things where I'm like, okay, I think I'm ready to launch something that's paid. It's really fucking cheap. And I think people would want to pay for it because if you're a Palantir investor, this is one of those things you're going to want to have inside of your arsenal. And I think a lot of people would use it either daily or weekly when they see the product. So that will be launching at 10 a.m. tomorrow. And I'm super, super excited for it. Tried to make it super cheap. Tried to make the value exceed the cost. So if you're interested in that, you guys can come back 10 a.m. and we will check out this product. Johnny says, what does it do? I will answer that in one word. It does everything when it comes to Palantir. It does everything. So it's going to be exciting. It's going to be exciting. I'll do a whole sales presentation. You guys can sit back and kind of be like, all right, man, sell me on this thing. You can sit back and just be like, all right, we're at a sales call. See if you can sell me. And for those that don't know, I was the number 7 debater in the United States of America, 3rd best public speaker in Europe. I have a bit of a debate history. So selling is in my DNA. I love selling, but I love selling when I'm actually selling something real, kind of like Palantir. They have software that actually works. That's why they're willing to sell it. So it'll be a fun presentation tomorrow at 10 a.m. Bitcoin right here, 65,750 right now. So Bitcoin falling from that 67,200 range. Matterport is up about 1%. ChargePoint, they're down 10%. They had a crappy earnings yesterday. Nvda continuing to go higher. It's at 872. It's fallen from 880, but still is up about 1.48%. Nvda not stopping. The Jerome Powell testimony is about to, and it is officially beginning. Here we go. Jerome Powell testifying in front of Congress. He's going to be answering meaningless questions, but we all will watch because we all love the stock market. Here we go.
Titled The Federal Reserve's Semi-Annual Monitor. Note at the outset that this hearing has a hard stop of 1 p.m., which will be strictly observed. I see Chairman Powell smile. It's just 3 hours. I'll now recognize myself for 4 minutes to give an opening statement, and welcome back, Chair Powell. Since you last appeared before the committee in June of 2023, the conversation in Washington surrounding inflation has shifted significantly. To be clear, it's not because the inflationary fire has been extinguished. From the most recent data available, food costs are up 21% since President Biden took office. Energy costs are up nearly 32%. Shelter costs are up more than 19%. And you'll pay 37% more for a dozen eggs in America today. As you stated in January, people are still paying more for the basics of life, and the prices they're paying are still high. Families aren't happy about it, as you know, and as our colleagues know. But according to the Biden administration, many of my Democrat colleagues, they should be thrilled. In an attempt to score political points, many in Washington have decided the best strategy is to tell people what they're feeling isn't actually accurate. They claim Bidenomics has brought down costs, and their partisan so-called American Rescue Plan put our economy back on the right track. Of course, we know the opposite is true, since inflation skyrocketed soon after the American Rescue Plan was enacted, which was predicted by several former Obama administration economic officials. Instead of working to solve the underlying issues causing high prices, the administration has played the blame game, citing corporate greed and so-called shrinkflation. Some Democrats have even trained fire on you, Chair Powell, blaming interest rate hikes, which were necessitated by Democrat spending, for the high cost and brazenly calling you to make cuts prematurely. It's highly inappropriate for lawmakers to attempt to influence monetary policy. Chairman Powell, I have faith that you will not allow politics to cloud your judgment in the fight to tackle inflation. As I have always said, you're a steady hand, and I believe you are committed to the Federal Reserve's independence, as am I. Just as you have rejected the outside pressures of politically motivated agendas, I hope you will be just as attuned to the threats of politicization when the calling is coming from inside the House. Vice Chairman Michael Barr's so-called holistic review of capital requirements and the fatally flawed Basel III endgame proposal represent a concerning trend of partisan proposals taking priority over supervision. This has real-world impacts, as we saw 1 year ago this month when the supervision and regulation arm of the Fed was late catching up to the effects of the acceleration of interest rates on the banking system. Americans were understandably shaken by last year's banking turbulence. As we continue to monitor potential instability, including bank exposure to commercial real estate, it's critical that the Fed keep its eye on the ball. This does not include enacting new, far-reaching, and ultimately harmful regulatory policy, though. As you know, members on both sides of the aisle, on this committee and in Congress, have made clear that the Basel III endgame proposal would be catastrophic for families, communities, and small businesses. Regulators should withdraw it and start over. I think that's the proper course with something as deeply flawed as the current proposal. Additionally, given that other significant proposals would have to fit holistically together, regulators cannot simply proceed with them as separate modules or using a cut and paste approach. Most importantly, as the Basel III endgame proposal is discarded or altered, I strongly urge you and other regulators not to finalize the long-term debt proposal. Instead, Chairman Powell, I would encourage you to stick to the task at hand and follow the data. The stakes are way too high to put politics over sound policy. With that, I yield back, and I'll now recognize the ranking member of the full committee.
Thank you very much, Mr. Chairman. Good morning, everyone. Welcome back, Chair Powell. While I am pleased by the progress the Fed and the Biden administration have made to tackle inflation, we're not out of the woods yet. In fact, even though my Republican colleagues refuse to acknowledge this fact, housing is still the #1 driver of inflation. Based on the latest data, housing costs continue to make up nearly 70% of overall price increases, outpacing modest wage gains. This means that until we address the underlying housing supply shortage, Americans will continue to pay an increasing share of their income on housing. The affordability crisis will worsen and inflation will remain too high. With that said, it's hard to understand why Republicans feign concern about the economy when they're unwilling to address the key driver of inflation, housing. In fact, Republicans have only put forward legislation that makes things worse for millions of Americans, including moving legislation to slash funding for federal housing programs, including in rural America, where homelessness is rising. This abysmal record on housing is par for the course for Republicans. Since they have been in the majority, they have convened only 6 hearings on housing, on top of launching baseless impeachment efforts, censoring members, and pushing our government to the brink of multiple government shutdowns. It's clear that Republicans are too focused on drama and chaos to deliver anything for the American people. That's not how Democrats roll. When I was chair of the committee during the 116th and 117th Congress, not only did we hold 55 hearings on housing, but I and my fellow Democrats enacted 12 critical housing bills into law in the last Congress alone that helped stymie a tsunami of evictions, foreclosures, and homelessness, keeping millions of people stably housed during and after the pandemic. Unlike Republicans, we don't just talk about the issue. Democrats make law. As House Republicans continue to disappoint, committee Democrats are offering evidence-based solutions to keep a fair and affordable housing agenda at the top priority in Congress. That's why I and my Democratic colleagues reintroduce 3 groundbreaking bills to address the housing crisis and bring down inflation once and for all. This includes Housing Crisis Response Act, the Ending Homelessness Act, and the Down Payment Toward Equity Act. Together, these bills would create nearly 1.4 million affordable, accessible, and resilient homes, reduce housing costs in homelessness, and revive the American dream of home ownership for all. So, when my Republican colleagues are ready to get serious about our nation's economy and inflation, Democrats are ready to work with you to pass the bills into law. In fact, tomorrow at noon, I, committee Democrats, and more than 30 housing advocates will join together at a press conference to share just how important ending the affordable housing crisis is to the state of our union. And so I invite all of my Republican colleagues who say they care about this issue to come on and join us. I look forward to discussing this critical issue with Chair Powell today. And Mr. Chairman, I yield back my time.
Chair recognizes Mr. Barr, Chairman of the Subcommittee on Financial Institutions and Monetary Policy, for 1 minute.
Welcome, Chairman Powell. Runaway inflation and increased interest rates still have Americans reeling. And while the rate of price increases have come down thanks to monetary tightening, the overall level of prices remain high. The toothpaste is out of the tube, and Americans, the average American family, still is paying about $15,000 more for the same goods and services that they were purchasing just 3 years ago before the Biden administration. So Americans have suffered years of eroding purchasing power in their paychecks. And while I'm pleased the Fed is resolved in getting inflation back under control, I'm not pleased by the numerous recent unjustified, politicized, and underanalyzed regulatory proposals. The Fed needs to withdraw and repropose the irredeemably flawed Basel III Endgame proposal, especially given that 97% of public comments across the ideological spectrum express disapproval of the proposal. Chair Powell, I urge you to listen to the American people, withdraw the Basel III Endgame proposal, and tell us today what the Fed's plans are moving forward. I yield.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair Powell, for being here today. And I had a chance to actually read the monetary policy report from cover to cover, thanks to an exceptionally long airport delay, again, going back home last weekend. And the feeling I got again and again is that things are fairly well recovered from COVID and getting back to normal, that we're in the range where ordinary monetary policy and fiscal policy will allow us to satisfy your dual mandate. Today, unemployment remains near historic lows. Core PCE inflation is down to 2.8% year over year compared to a peak of 5.6% in 2022. And the major stock indices are hovering around record highs. GDP growth continues to beat expectations, and the U.S. economy has added more than 14 million jobs since President Biden took office. The GDP itself is pretty much back on the trajectory that it would have been pre-COVID. U.S. manufacturers alone have added nearly 800,000 jobs, employing more workers now than any point since 2008. And so my lesson from that is that the fiscal response that we engaged in was appropriately tailored, and the soft landing is within sight. Thank you. I yield back.
Gentleman yields back. Today, we welcome the testimony of Jerome Powell, Chair of the Federal Reserve's Board of Governors. As you know, you'll be recognized for 5 minutes for a summary of an oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. Chair Powell, we're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. And I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve. And we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates.
Guys, I'm just switching it real quick so you guys can see the person who's talking. If you want to keep saying Jerome, just let me know in the chat. But this angle has camera switching angles. Here we go.
It's going to be
and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to? And do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening to these comments that have been nearly unanimous in opposition to this rule? Is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right. We've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out. You would not rule that out at this stage of the game, reproposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that. This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the 3 components that we look at that make up the core PCE and, index, and it has been coming down from its heights of a couple of years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's been reported that the methodology used to assess housing costs as an indicator of inflation is imperfect, namely because it considers costs based on both new and old rent, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry,
Wrong Vice Chair.
wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics. And you all discuss the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively, but yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets, in abundance of caution in case there needs to be a resolution. Obviously, we know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level. And that seems redundant to me. Are you aware of that? And have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back. And so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important, the implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households. And in my view, there's three principal causes. Certainly we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at, but the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks. And so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now. And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference, because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains was disrupted. In fact, I could be Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the, of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet, just about. Is that not correct?
I think that's right. Yeah.
And I think that you also recognize a mismatch between the strength of the economy, that's what we're talking about, in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high in people. So that's something else that we need to get in control. Is that not correct?
Yes.
And let me just ask this. Can you say that there's a connection, for example, between conflicts in other areas of the world, like Russia's war against Ukraine and or the turmoil in the Middle East and the economic pressures that the United States feels? Does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly the war in Ukraine caused commodity prices to move up sharply.
So could you tell you what is the, what would the connection lead you to believe that there is an urgent need for us, I would think, for, when we're running out of time, for us to do everything that is in our power in Congress to support Ukraine, so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction. So I wouldn't have an opinion on Ukraine funding.
But if we had more grain that was going through, it wasn't blocked by Russia, things of that nature, that generally just, says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia. And we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
I think it's correct that a full supply of grain would help with commodity prices.
And so, you know, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this longstanding work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Boswell endgame warrant a full reproposal to give us time to appreciate their consequences. And there are real consequences, as you and I both know, Mr. Chairman. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. And welcome again, Mr. Powell. It's an honor to have you before us today. I always enjoy hearing your commentary. As you know, recession and inflation, these are buzzwords, and they are used in some circumstances to cast a dim light on perhaps the Fed and others who are working to end some of these troubling circumstances we're dealing with. Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation and that of other forecasters and of my colleagues is that we'll see continued growth at a solid pace. I will say, so there's no evidence or no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate you saying this because we want to, at some point, eliminate the great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely. Are you of the opinion that we're headed to a soft landing, Mr. Powell?
I'll just say that what we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand. And inflation has come down sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions, and we're trying to use our policies to keep that growth going and to keep that labor market strong while also achieving further progress on inflation. That's our goal. And do I think there's a possibility we can achieve all of that while keeping the labor market strong and the economy growing? Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. We could possibly have a soft landing and miss the point at which the landing took place. How do you define the soft landing such that a member of the public, a layperson, would understand that we have indeed had a soft landing?
So we really think about it in the terms I just discussed, which is we want to keep the economy growing. We want the labor market to remain strong. 3.7% unemployment is pretty near 50-year historical lows. We want inflation to continue to move down closer and closer to that 2% objective. And we've made quite good progress on that over just the past year. So we want to continue those conditions. And I don't want to put the label on it. Other people can do that. But I would just say we're using our tools to keep a strong labor market and strong growth while making further progress on getting inflation down to 2% for the benefit of the public. That's the economy that we're trying to achieve. And I think there's we're on a good path so far to be able to get there.
Well, I concur, but I would ask this as my last question. Will there be some announcement at some point that we've had a soft landing? Because we have people who are continually indicating that we're not having a soft landing, there's a possibility of a recession. So will there ever be some official statement that would give people some comfort?
I don't think by us, no. I think we're just going to keep our heads down and do our jobs and try to deliver what the public is expecting from us. We wouldn't be, declaring victory like that, but
The gentleman's time has expired.
Thank you, Mr. Chair.
thank
The
you.
gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome back. I think we enjoy this. I hope you do too. I know there's some bit of trepidation about all the things that are available to us and you to answer. I learned a long time ago on a campaign trail, every problem can be solved on a campaign. Reality is a little bit different. Welcome back despite all that. Looking at the Monetary Policy Report, March 1st, 2024. And as I review this, I would like to focus on the term that I would say high prices are here to stay. Because what I've heard you say today in this report really go to is you got everything under control, but we're going to keep the high prices. And I think the high prices really take a toll on the American people, as you're hearing from our colleagues, no matter whether they be Republican or Democrat. Page 7 of your report, you don't have to go focus on it. It says, while current services, core service price inflation has been slowing, but remains elevated. It does. Labor costs, as you know, and energy costs are a driver to your monetary policy. The question that I have is, because you began referencing policy, 2 weeks ago or so, the president announced that he was going to slow down the gifting of opportunities in Texas for natural gas to be able to continue the exploration. And this in Texas is a $1 trillion answer problem to us, because if we do not constantly go find through these new finds, but also through the permitting process, we're in trouble. But we're also putting in trouble our contracts that we have with Germany and a lot of other countries. This is going to mean also that business in America continues to have high prices because, as you know, wages are already high and now energy is high. There's no resiliency to continue this and see the American people win. You talked about policy. So what's your advice to policy about energy and what this administration is doing on a policy perspective?
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting on.
But it has a huge impact on this report. It arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just going to leave that alone?
Really not appropriate for us to comment. On if I'm commenting on energy policy, I should comment on everything.
Well,
we have a mandate which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Okay, well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry, jobs that are associated with it, our foreign policy as it relates to contracts that we have signed with foreign countries, giving up the natural gas market almost entirely on a world market to Qatar. It has a huge impact on whether we are going to keep prices high or control these prices. It has a huge impact on, I think, your monetary report about how many houses get built, how many jobs get filled, whether we have jobs in place, whether we continue to have more jobs available than workers that are there, because over-regulation is having a lot to do with the nervousness, not only on this panel, but also by the American people. It would be my hope that you would pass some sort of a memo and tell them you have no opinion, but you want them to see what the impact is. I want to thank you for being here. Thank you, Mr. Chairman. I yield back my time.
Gentleman yields back. The gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thanks for being with us today. I have a question, but I want to start by acknowledging, not celebrating, but acknowledging what has been a really remarkable soft landing in our economy. And I'm not celebrating because the American people, consumers, are still feeling the effects of high prices. Wages haven't caught up with prices in some instances. But I think that it would be fair to say that observers would never have predicted the conduct of this economy. You yourself said it in the final press conference of 2023 when you said a very high proportion of forecasters predicted very weak growth or a recession. Not only did that not happen, we actually had a very strong year. So I want to acknowledge that and acknowledge your commitment to independent monetary policy. And because I'm still burdened with this idea that truth and facts matter, I want to point out, especially having listened to my good friend Mr. Sessions talk about the energy market, truth and facts matter. We are producing more oil and natural gas today than any other country on the planet. We are the world's #1 energy producer. I could spend my entire 5 minutes sort of pointing out facts. The fact I want to point out here, and this comes right out of the report, is that the premise that inflation is Joe Biden's fault, is fiscal policy's fault, first is faulty because half the fiscal stimulus that occurred in the face of the pandemic happened under the previous president, Donald Trump, and it has faded. And this report makes the case. Core, and I quote from it, core goods prices have been declining as supply bottlenecks ease and import price inflation falls. So, Mr. Chairman, I don't want you to comment on that because it gets a little bit political, but I do think it's important that we keep some foot on the plane of facts. I do want to ask you a question, though, Mr. Chairman, because I always worry about risks that we see and risks that we don't see. And I want to use the remainder of my time to talk about a risk you're very conscious of, which is the overhang in the commercial real estate market. As you know, the Financial Stability Oversight Council identified commercial real estate as perhaps the most salient risk to the financial system, $6 trillion roughly in loans, half of that on bank balance sheets. In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it? It makes me nervous because this has echoes of 2008, 2009, when vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been working hard to management for some time now, really. And what it really is it's a lot of downtown real estate where there's too much office supply because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations, and we've been in touch with them to make sure that they have a plan to deal with that. There will be losses by some banks. It isn't really the big banks. It's really medium and small sized banks that have these higher concentrations. It's going to be with us as a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to take the losses that you're probably going to take. And so that's what we're doing. We're very active in this space with small, medium sized.
So let me ask you about that. Sorry to interrupt, but let me ask you about that. Silicon Valley Bank, wild irresponsibility inside the bank, egregious irresponsibility on the part of corporate treasurers who put so much on deposit. The Fed also had some self-examination to do because the examiners and the supervisors of the bank, quite frankly, were not doing what they should have been. So we might be forgiven for being a bit skeptical of claims of being on this. What has changed in the context of Silicon Valley Bank that gives you the confidence that the supervisors and the examiners will be on top of this?
I see it with my own eyes, but I mean, frankly, there's a risk that we would overreact to something as significant as that. It's not like we wouldn't have reacted very, very strongly to what happened with Silicon Valley Bank, and we have. So I know that our supervisors are out there, and we're hearing back from media reports that we have been engaged with medium and small sized banks principally on this. So I am confident that we're doing the right things there. And I do believe it's a manageable problem. If that changes, then I'll say so.
Thank you. Thank you, Mr. Chairman. Yield back.
The gentleman from Missouri, Mr. Lukemire, is recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you, Mr. Powell, for being here today. I'd like to associate my remarks, or myself, with Mr. Hill's remarks earlier with regards to FDIC proposed long-term debt requirements that are based on risk weighting of assets. I think it's an ill thought out proposal, and hopefully your position on FSOC, you'll be able to advise them and hopefully guide them that this is going to be held up until we actually get a Basel III rule. In October 2023, the board issued a proposal to update the debit interchange fee cap and regulation II. This is very concerning, given the data from both the GAO and Fed's own studies show that Reg II has significantly harmed access to free checking and other banking services for the country's poorest citizens. Yesterday, I introduced the Secure Payments Act, which would prohibit a final rulemaking until the Fed, among other things, studies the impact of the board's proposed rule, completes a quantitative impact analysis specifically as it relates to affordable banking services for low-income Americans, and reports those findings to Congress. I understand the Fed acted here because you feel you're facing litigation, but I urge the board to proceed with extreme caution with any type of price control proposals, especially since the first iteration was so clearly harmful. Chairman Powell, knowing of the hardship caused by this policy on low-income consumers, does it give you any pause to continue down this road?
As you know, this rule is out for comment. We extended the comment period to May 12, so we don't have all the comments yet. We'll evaluate them carefully and make an assessment. I mean, the law does assign us a specific job, which is to assess whether an interchange fee received by a large debit issuer for processing a debit card transaction is reasonable and proportional to issuer costs. This is the obligation that Congress has bestowed upon us. Not something we thought we sought, but that's our obligation under the law, and we don't know what else to do than to keep doing it for as long as that's our assignment. That's all we think we're doing, but I think that the concerns that have been raised will be things that we.
Well, hopefully you'll study this and understand that from the previous types of rules along this line, they were very detrimental to a lot of low-income, middle-income folks. As you know, the price reductions that were promised during the Durbin Amendment, for instance, the added profits actually went to the largest retailers rather than go to the consumers as they were talked about. 98% was one of the studies that showed that the retailers kept all the money instead of lowering prices as they were telling us that were going to happen. So I'm very concerned about that. So what's the legal basis for updating your regulation? You've talked about it a little bit. You believe that there is something in the law that says that you need to be doing this updating all the time, or should you be studying it before you actually propose a rule and make all these things more appropriate?
Well, again, I think our reading of the law is that it's not something you do once and leave it there. It's supposed to be reasonable and proportional to certain identified issuer costs. The implication being there, if those costs change, then this should change. So that's our reading. I think we do a lot of work. We waited a long time to change it. It's been many years since we did change it, but we do quite a bit of work to make this assessment, and we'll review the comments and the data that we get.
One of the things I hope that you consider is the fact that even though it's supposed to be on $10 billion and up, stuff all rolls downhill, and as the last study showed, the smaller banks, the community banks, are also feeling effects of this. So be sure and consider that when you start talking and thinking about this. I appreciate that. One of the things yesterday I had two different foreign banker CEOs in my office, and one of them brought up the subject to me, which is very concerning with regards to artificial intelligence being able to impact financial institutions in this country and our banking system. And I tell people, I said, think about this for a second. You find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now, that individual didn't do this. It's artificially produced. I've seen a commercial already with individual. You couldn't tell the difference between that individual and the real thing. We have just come through the Silicon Valley situation. And if you have real-time payments, FedNow, where you can instantaneously transfer money, and you have people scared to death by some well-known individual through an artificial intelligence situation, and I can tell you China is watching this like a hawk. They are ready to pounce on this situation. To me, I've got some bills that actually would solve the problem. Do you think there's some issues here we need to be taking a look at?
Yeah, I think we're very focused on AI, many government agencies and law enforcement agencies in particular. It's very challenging. You paint one picture. There are lots of pictures.
Gentleman's time has expired.
It's interesting because the foreign
Gentleman's
banks
time's
actually are watching this. Thank you.
We'll now go to the gentlewoman from Texas, Ms. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thank you for being with us this morning. It's always a delight to have you before us. Chair Powell, the February Congressional Budget Office report estimated that the U.S. economy will grow an estimated $7 trillion over the next decade, thanks to, in large part, to the surge in immigration, creating a larger labor force. Immigration also increases demand for goods and services. I know you mentioned in your report that that the growth sometime during COVID was held down due to some restrictions in COVID and restrictions on immigration. Can you detail how immigrants have been fueling our national growth? And did you consider this report from the CBO in this current report?
So I am very familiar with the CBO report. I've read the demographic projections and I've read the economic projections, so I do understand what they did. And
so you do agree with a $7 trillion growth in the next decade?
I have no judgment on that. I haven't tried to make a parallel assessment, but I'm familiar with the assessment. What they're doing is they're saying more people working, bigger economy, and it makes the economy bigger. It's just arithmetic. If you say that if you add a couple million people to an economy, and a percentage of them will work, then there will be more output, and that's what they're showing. I just want to be very, very clear, though, that we don't make immigration policy. We don't comment on immigration policy indirectly or directly.
No, well, I'm not asking you to do that, but Mr. Chairman, I'm simply asking if you agree that the immigration surge has added to our strong labor force, which is necessary. I think you said that we expect a continued growth at a solid pace. So to be able to continue on a solid pace, then we need that labor force. Wouldn't you agree?
Well, so last year we got a big increase in workers, and it came from two sources. One was participation increased from people who were already here. And in addition, we got a significant increase in immigration, and many of those people take part in the working economy. And so there was a big increase in labor supply that will have increased output. It will have made more people. It will have all kinds of economic effects. I'm just reporting the facts there.
Right.
I'm not going to say anything is needed for the future or good policy, or indirectly or directly, but I mean, I think it's just reporting the facts to say that immigration and labor force participation both contributed to the very strong economic output growth that we had last year.
Right. Is it possible for the Fed to conduct a formal assessment into the positive impact immigrants have on our economy and report back to Congress?
Not really, no. I think that's a job for the CBO. We don't. That's precisely what the Congressional Budget Office does, not what we do.
All right. But the other question that you've not addressed is, did you consider the CBO's assessment that the growth in the next 10 years would be $7 trillion and about $1 trillion in added revenues? Was that considered in this report? Because that was the February report, and this, I believe, is through February 29th.
So I think that the answer to your question is 10-year growth projections by CBO don't have big implications. They don't have any implications really for the current stance of monetary policy. But I will say that the immigration that we saw was a a notable factor of the 2023 and 2024 economic outcomes. And of course, we're aware of that, and it plays a role in our thinking about appropriate policy and the path of the economy.
Okay, well, thank you for that. And related to that, I know that the last time that you were here, you and I talked about diversity and diversity inclusion efforts, both at the Fed, and I applauded you and well applauded the president for his appointment of Dr. Adriana Kubler. I expect to visit with her this week. What other strategies and programs are you using in the Fed, not only in here, but in all the branches to ensure that there is diversity and inclusion?
So in terms of intake of people, when we go to hire when the reserve banks go to hire a new president, those processes are very focused on having a diverse applicant pool. And you see the results of that more and more over the years. That happens. We don't have any role in appointments of governors, so that's not our job. The administration does that. In terms of, I'll just say internally, we're very focused on having an open and inclusive place to work. And also in hiring, we work hard to have diverse.
Gentlelady's time has
Thank you.
expired. The
Thank you, Mr.
gentleman from
Chairman.
Michigan, Mr. Heising, is now recognized for 5 minutes.
Chairman Powell, good to see you in person. Mr. Chairman, I've got to make a comment here. It's stunning to me that equating an underground economy, which is very different and not a healthy alternative to the regular economy, and basing that on an illegal workforce that's not legally able to work, ultimately will fail. That is not a strategy to my colleagues on the other side. So just ask any farmer who's going to then have a regulator come in and fine them for employing people who are not legally allowed to be here in the country. That is one of their greatest fears. So that's just a fallacy of growth within this economy that is not sustainable. Chair Powell, last fall I sent Vice Chairman Barr a letter expressing my concern over the cumulative impact pending rulemakings governing products and services will have on consumers. This morning, there's been a fair amount of time spent on Basel III, but among the agencies, and here I'm including Fed, FDIC, OCC, CFPB, and the number of pending or final rules is frankly just staggering. Regulators last year finalized new rules for the Community Reinvestment Act. The Fed is also looking at Reg II, which in my opinion would unintentionally undermine recent significant progress in bringing low and moderate income consumers into the mainstream banking system. And just yesterday, the CFPB unveiled a rule that would cap late fees for banks. And I just literally walked out of a meeting with my credit unions who are very concerned about those things that may be in their future as well. So I think it's critical that we don't look at any of these rules in a vacuum, and we need to consider their total impact and full scope on that. So I'm going to ask you a question I've asked some of the other regulators. How much do you, as the Fed, and you personally, consult with other agencies on their own rulemaking agenda? Do you coordinate? Do you talk?
So I don't lead that area of our business, but I know there's a lot of talking. Coordination, I'm not sure there is coordination.
We're in government. There's always a lot of talking. I'm
much
concerned
talking.
about
No
the
shortage.
coordinating. All right, well, let me ask you this way. When a rule is finalized under another regulator, are you mandated or have any kind of policy to go back and look at your other pending rules under your purview and see if changes need to be made because of these other agencies' rule makings?
There's no mandate like that. I think where it made sense to do that, though, we would do it.
But you genuinely have some sort of review of that. It's conscious.
I don't think there is a formal review.
Okay.
No.
I've heard repeatedly that elements of Basel III overlap with the Fed's annual stress tests. What are you going to do to address that overlap?
So we're in the middle of just at the beginning, actually, of deciding what to do about Basel III. And part of that may be the interaction with the stress test. So I haven't got anything for you on that today, but that's certainly an issue that presents itself.
Would like to continue that conversation. I do want to touch on the bank failures of last year very quickly. Do you think that the banks that ultimately needed the government bailout lacked sufficient capital, or was it more of a management problem?
So with Silicon Valley Bank, it wasn't really, could they have used more capital? I mean, they were actually raising capital. It was a capital raise that they announced that triggered the run and everything. So you can argue that it needed more capital, but I wouldn't say that that was the proximate cause, really. It was a funding structure that was all about too much concentration of
Well, many
uninsured
of
deposits.
us are, I'm asking the question because many of us are very concerned that those failures are being used as an excuse to raise capital standards across the board. And because the SEC just released its climate disclosure rule this morning, I'm going to touch on the climate related question for you. FSOC, the FSOC chair has repeatedly stated that climate change is, quote, an existential threat. Presumably a threat that is existential affects banks and financial institutions of all sizes. Why then have FSOC member regulatory agencies, including the Fed, limited their guidance on climate-related risks only to large financial institutions? Why not everybody?
Well, it's a new thing, and we are not.
It's a heck of a new thing. Yes.
We're not climate change policymakers. It's this is
Either is
something that
the
needs to
SEC,
be
I might
handled
add.
by elected representatives, and so we're starting this very carefully with large institutions who are already doing it. By the way, the things that we're doing, they're doing this because to remain active internationally, they have to be doing it. So we started with them because they understand it. Imposing it on smaller banks, it's not something I'm for.
Yep.
Gentleman's time has expired.
We'll
The
be
gentleman-
following up on the Taylor rule. So.
The gentlelady from Michigan is recognized for 5 minutes. Ms. Salib.
Thank you so much, Chairman. Thank you, Chair Powell, for being here. Do you agree with the April Federal Reserve report that compensation incentives contributed to Silicon Valley's bank failure?
I'm sorry, did I didn't
So the April Federal Reserve report, it said that compensation incentives contributed to the Silicon Valley Bank's failure. Do you agree with that?
I would say it's at best a tertiary factor, but it probably had something to do with it. For me, not a major.
So that's no?
That's very small.
Okay, so it did. Okay. So do you agree the appropriate rules on incentive compensation could have reduced the likelihood of Silicon Valley's failure? Maybe. If they didn't take
No,
all that
I
money.
really don't think so. I mean,
So if
I
they
don't
didn't
think
take all
it's
that money?
I don't think it's a first order question for Silicon Valley. A lot went wrong there.
Yeah.
Incentive comp would be.
They actually blame
way
you
down the
guys.
list.
They
Sorry.
blame the oversight, even though they didn't respond to your
That's part of it.
correspondences.
We took our medicine.
Yeah. Do you think it also has something to do with the fact that Section 956 of the Dodd-Frank rule hasn't been finalized by you?
No, I don't.
You don't think it's the reason?
I don't.
You don't think it's because people made money off of the failure?
I think nothing.
You don't think money drove them to do what they did?
I didn't say that. I did what I said. There are lots
So
of.
they made money from it. They actually, it was a lottery
I
for
do not
them,
think
right?
that incentive compensation arrangements were at the heart of the Silicon Valley Bank failure. No.
Okay. Do you support a robust rulemaking for executive compensation, Chairman?
I know that the.
Oh, you don't?
I'm sorry.
Oh, this is, do you support robust rulemaking for executive compensation? Do you believe in Section 956?
Section 956 is the law. As I understand it, the agencies are looking at doing something. It's been 12 or 13 years, right?
Yeah, multiple
Nothing has
agencies.
happened.
Yeah.
It's been hard to get it done. I lived through the last episodes of trying
Yeah.
to get it done.
So do you believe in a robust
I
rulemaking
believe-
process for executive compensation?
I do, yeah.
Oh, great. Oh, that's awesome. Will you commit to helping finalize the Dodd-Frank section of 956 this year?
I wouldn't
It's been
say that.
12 years, Chairman.
Yeah, no, I want.
It played a role in the bank failure, Chairman.
If I can answer, what I would like to do is.
So you don't want to do it this year? I mean, I'm being serious. You're saying no?
If the member will allow the witness to answer the question, we've had a good day today and the gentleman's trying to answer the question.
I would like to understand the problem we're solving, and then I would like to see a proposal that addresses that problem.
Okay. Do you believe people should profit off of bank failure? The executives that made those decisions?
No, not
They
the
should not
executives.
profit.
Well, I would say executives who are responsible for a failed bank should not profit from the failure. Absolutely not.
So they get to walk away with compensation based on their failure?
Well, you're asking,
true,
you're
it
asking about
happened.
a different rule that would do have clawback and things like that?
Yeah.
Yeah, so that's something I know you've been looking at for a while.
Yeah.
That's certainly an appropriate thing to look at.
Yeah, because it's just going to continue to happen, is my opinion. It doesn't have to be yours, but it sure the heck could have helped here if they knew they were going to walk away, if they could walk away with not the bonuses, the compensation. I mean, they made money, a significant amount of money for their bank failure. Last question, Chair Powell. Do you believe that the impacts of climate change pose a risk? Have you been talking about that more?
I certainly believe that climate change is real and poses risks over the longer term. Sure.
So there have been some that say, you know, higher interest rates actually makes it more difficult to build out the renewable energy projects and other investments required to prevent climate impacts. Do you believe that to be true?
You know, it's not our, I believe that we need to do our job that you've assigned us, which is maximum employment and price stability, and we do it through interest rates. It's not our job to consider the effect on climate change of that. And I think any effect on climate change of that would be kind of minuscule.
Okay. Last question, Chair Powell, who do you see as the major winners and losers from high interest rates in terms of income groups, age groups, and racial or other demographics?
So the point of high interest rates in the current environment is to bring inflation under control. The people who are hurt the most by inflation, as you know, are people who are on a fixed income, who right away are in trouble when the cost of transportation, food, energy, and when those things go up, they don't have financial resources to deal with it.
Have you looked
We're
at the-
accountable to provide price stability to the American people. Those people benefit the most over time from stable prices.
Gentlelady's time's expired. We'll go to the gentlelady from Missouri, Ms. Wagner, for 5 minutes.
I thank you, Mr. Chairman, and I thank you, Chair Powell, for your service. I want to associate myself with the comments of my colleague, Mr. Himes. I am concerned about banks' commercial real estate exposure, and I do hope that the Fed is doing everything it can to ensure that the exposure that these banks have will continue to be, in your words, manageable, because this is a looming crisis out there, given the workplace changes and dynamics. Chair Powell, in remarks on Bloomberg, Larry Summers, former Treasury Secretary during the Obama administration, stated that, and I quote, "It would be much more productive for our central bank to be focused on the question of real estate portfolios in the banks they supervise than, quote, some of the more abstract and politically driven arguments that about various kinds of capital charges on the largest banks." Do you agree, sir, that it would be more productive for Fed supervisors and regulators to keep their eye on the ball, in this case, commercial real estate and other real estate investments?
I absolutely think we need to keep our eye on the ball on commercial real estate. And I think we're doing that.
I hope so. According to your semi-annual report, the median of members on your Monetary Policy Committee estimate that your target overnight interest rate will average 4.1% in 2024. Does that mean that the median number of members anticipate that you will be cutting interest rates sometime this year by as much or more than a full percentage point?
No, it doesn't mean that. Actually, the Summary of Economic Projections showed a median of, this is in the December FOMC, so this is now 3 months old, showed 3 rate cuts this year. So that would be 75 basis points, 3/4 of 1 percentage point. You were quoting the next year's number, so you would add that on. That was through 2025, I believe.
So are you anticipating that there would be more cuts here coming?
It's not, the way I would say it is, we're making economic projections. And so we write down a path of growth, what's happening in the labor market, what happens with inflation, and what goes with those forecasts is an appropriate monetary policy, appropriate interest rates. So we expect inflation to come down, the economy to keep growing, the labor market to remain strong. And if that's the case, it will be appropriate for interest rates to come down, significantly over the coming years.
Good.
What will really happen, though, it's not a plan. What will happen is actually what the economy needs. The economy will do something different from that, and that's what will actually happen.
Chairman Powell, 15 members of Congress, including myself, Ranking Member Sherman, Chairman Barr, and Ranking Member Foster sent a letter to the prudential regulators regarding the impact that Basel will have on U.S. capital markets activities. The letter highlighted critical areas of our U.S. markets, including securities underwriting, securitization, and derivatives that will be severely impacted by the Basel proposal. This was also a common theme represented throughout the comment file on the Basel proposal, over 95% of them. Considering that 75% of financing in the U.S. is done through our capital markets, which are the deepest and most liquid in the world, why would the Fed continue to pursue this flawed proposal instead of re-proposing a rule that would not have such a drastic impact on the U.S. economy?
Well, in fact, the capital markets concerns you raised are among those that I raised myself in our open board meeting when we put this out for comment.
You said you wanted broad support, and obviously there is dissent among some of your governors, the FDIC, others. So how are we coming on this, and how are we
we're working our way through the comments, and we're coming to the point where it'll be appropriate for us to begin to evaluate what changes are appropriate. I've said I think those changes will be broad and material, and that's where that is. But we haven't made any decisions yet. We just got the comments.
In my role as chairman of the Capital Markets Subcommittee, I have seen SEC Chair Gensler push the envelope in terms of rules and regulations that go well beyond the congressional mandate, even encroaching on the jurisdiction of other financial regulators. What is the Fed's response to another agency encroaching on its jurisdiction?
We do not comment on other agencies' regulation. However, if they were actually, to take your hypothetical at face value, if they were to come into our jurisdiction.
Oh, it's more than a hypothetical.
And we would react.
Good. Well, I hope you do. I yield back.
Lady from New York, Ms. Velasquez is recognized for 5 minutes.
Thank you, Mr. Chairman. Right here.
Hi.
Hi. Thank you for being here, Chairman Powell. Property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in my community. The FSOC's annual report identifies property insurance rates as an increasing risk, and I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomic?
That's an audio thing. Yeah, so it's not.
Pause the clock. You can have staff take a look at the microphone.
Okay, so it's not just us; it's the actual audio.
We need
The clock being frozen is out of respect for Ms. Velasquez, or out of good luck. I'm not sure.
The clock.
Well, we'll get staff to listen. We'll just suspend for a moment.
We need to invest in infrastructure. For the community.
Yes. We're trying to do electronic voting, and
Oh my goodness gracious, guys!
it's hard enough to just get the microphones to work. Madam
So
Clerk.
far, we have been asked about DEI, climate change, Ukraine. They know Jerome can't
So
answer this
all the
stuff.
photographers have left, so the awkward photos for Trish will be less awkward.
This is insanity. Palantir 2596. They are asking him questions that they know he can't answer, which is the sad, toxic part about this testimony. But they're still asking him these questions, and they know he can't do any of this. Like, he could lose his job if he's this political, but they're still trying to bait him into this stuff, which is the sad part about Congress. Bitcoin 66.7, MicroStrategy up 16%, Robinhood 16.24 up 2%, PayPal 58.49 up 0.38, SoFi up 2.44%, 7.45, Palantir 25.98, trying to get back to that 26 level. Google down 1%, Apple below 170 officially. Uber's up 1%, Mag 7 having a rough day outside of Nvda. Nvidia's up 2.4%, 881. Tesla 176 down 2%. Amazon's up a little bit as well.
It may not be better, but it's a different one.
Ethereum 37.95. We still don't have the mic. This is hilarious, dude. This is crazy. We're the most developed country in the world. We don't have a fucking microphone. Insanity. But this is, and again, this for 3 hours, I just think we pay for JPOW, we pay for Congress, at least American taxpayers. And for 3 hours to spend on questions that are all political stuff that JPOW can't answer is just sad that our money's funding. It's really sad. But it is what it is. That's what's happening right now. CrowdStrike's up 10% for the day. S&P 510 as well.
Oh, this one's back. Now this one's back. Okay, great.
I agree, John. Both
Doesn't
sides
want to be
bait.
replaced.
Both sides bait. Republicans and Democrats. They're
Okay.
baiting him into something, but it's sad
So,
that it's happening.
right, we'll start over. We're going to restore the clock. Thanks for members' indulgence. Ms. Velasquez, you're recognized for 5 minutes.
So, Mr. Chairman, I was asking you about the property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in our community. The SOX annual report identifies property insurance rates as an increasing risk. And I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomy?
So yes, we are very much aware of increases in insurance, including property insurance, and it's been adding meaningfully to inflation. It's not something we have any control or authority over. Same is true of auto insurance. They're just insurance generally prices have gone up a lot.
So when we talk about the lack of affordability when it comes to housing, the insurance, the rising cost of insurance is an important factor that is affecting the availability of affordable housing in our communities. And I hope that there are some discussions among the Fed because it is an increasing risk and it's going to have a direct impact on our economy. Chairman Powell, I know you spoke with Chairman McHenry a little bit on inflation and interest rates. Can you explain what evidence you're looking for before inflation has returned to 2% and interest rates can be cut?
Sure. So we're not looking for inflation to go all the way down to 2%. That's not what we're looking for. What we want is just more evidence that will give us more confidence that inflation is on a path down to 2% sustainably. So that will come in the form of good inflation readings, really. We want to see, just a bit more evidence so that we can be confident. We don't want to have a situation where it turns out that the 6 months of good inflation data we had last year, that didn't turn out to be an accurate signal of where underlying inflation is. So we're just being careful. And because the economy is so strong and the labor market's so strong, we think we can and should be careful as we approach that decision.
And when you say evidence, what evidence? If there's anything.
So just more, we'd like to see more good, relatively low inflation readings. We're not looking for better inflation readings than we've had. We're just looking for more of them. And what will happen is as we go forward, the 12-month inflation will continue to drop because it'll be lower than early last year.
Thank you. Mr. Chairman, I would like to pick up on where Ms. Tlaib left off and reiterate the importance of the rulemaking on Section 956. This is an issue that I also raised with Vice Chair Barr, Chairman Grunberg, Acting Comptroller Sue, and I told them when they came before this committee that I will be asking for a status update on the rulemaking at every future hearing because it's well past time, 12, 13, 14 years. If you are employed in a company and you are given a task, I will think that you will be fired if you don't get it done and it has taken 12 long years. So you are the chairman of the Fed. How is the Fed working with other agencies to propose the rule?
So there's a lot going on in regulation at the Fed right now. My understanding on 956 is that there have been discussions between the regulatory agencies, and I think it's not 3, I think it's more like 6 agencies that have to agree.
I know.
I have not seen a proposal. I think something is under consideration, but it's not something that's gotten to me yet.
I will ask the next time, and believe me, I'll be here.
Great.
Thank you.
Gentleman yields back. Gentleman from Kentucky, Mr. Barr is now recognized for 5 minutes.
Mr. Chairman, good to see you. You have said numerous times that the capital framework is about right and that banks are well capitalized. Do you still believe this?
I do.
Given that you believe that, and given the fact that the Basel III Endgame proposal dramatically increases capital requirements on banks, would a reproposal that implemented Basel III in a capital neutral way, could it do so without jeopardizing financial stability?
Could. I mean, hypothetically, yeah.
Okay. According to Latham and Watkins, 97% of the comment letters either opposed, called for a reproposal, or expressed substantial concerns about the Basel III Endgame proposal. And those negative comments came from across the ideological spectrum and from various interests. Without objection, I would ask the chair to include that report into the record. Without objection, I'd ask the chair to include that report.
Without objection.
Thank you. And Mr. Chairman, did you see that report?
I did.
Does that concern you, that 97% of the comments were negative?
So we didn't do our own count, so I can't make an assessment, but I would say it's unlike anything I've seen.
The Basel III comment period ended on the same day as the Fed's data collection on the proposal, which is an odd process since the data should have been collected far earlier, analyzed, and the results should have been available for the public to comment on before the comment period ended. Why did the Federal Reserve choose to do a quantitative impact study during the comment period for the proposal, foreclosing any ability by the public to comment on the results of the study?
Well, I mean, the movie's not over. We are where we are. And Vice Chair Barr did commit to putting the QIS out for comment. We will receive those comments, and those comments will be taken into consideration as we think about the path ahead.
Well, speaking of process, you've got your excellent general counsel right behind you there. And I don't want to get into privilege here, but have the lawyers at the Fed raised any process concerns or Administrative Procedure Act issues with the board?
Let me just say that we're committed to doing transparent and reasonable and data-based rulemaking in compliance with the Administrative Procedure Act.
Well, of course, giving the public the ability to comment on the quantitative data that has been provided obviously is consistent with good process. Sir, Governors Bowman and Waller, Vice Chair Hill, and Director McKernan all dissented on the proposal, and Vice Chair Jefferson expressed concerns with it during his statement. Under your tenure as chair, can you identify any other regulatory proposal which has elicited this much dissent?
No.
Have you in the past acknowledged in front of this committee that you will not move forward with proposals without consensus? Or you have acknowledged that in the past, that we appreciate that commitment to consensus. Have you achieved consensus yet on the Basel proposal?
Let me say I am confident that we will, but that's a process that we're as I mentioned, we're evaluating the comments. We're just coming to the place where we're going to start talking about the path ahead. And I am confident that we'll achieve very broad support on the board.
Mr. Chairman, do you agree that the heterogeneity and business model diversity within the banking sector contributes to system-wide financial stability?
I strongly do.
And do you agree that a concentrated business model in the banking sector would present a potentially systemic risk?
Potentially, yeah.
And this is one of my major concerns with the proposal, Mr. Chairman, because by de facto repealing regulatory tailoring, subjecting Category 3 and 4 regional banks to one-size-fits-all standards that currently only apply to large GSIBs, discouraging securitization, which is the private sector solution for dispersing risk, eliminating the use of internal risk models, and transitioning the industry and regulators toward only a standardized framework, actually would push the industry into a smaller and more concentrated looking industry, and as a result would, in my view, actually increase systemic risk and decrease market competition. Do you share that concern?
I think it's a real concern. And again, I think that's part of what goes into my thinking, certainly about the proposal and where it needs to go.
Well, given all of these concerns, we hope that you can commit to reproposing the Basel III endgame. And we strongly urge you to take that into consideration. With that, Mr. Chairman, I
Gentleman from
appreciate the
Massachusetts,
time.
Mr. Lynch is recognized for 5 minutes.
Good morning, Mr. Chairman. Welcome. Good to see you again. I want to go a little deeper into the commercial real estate issue and the potential impact on regional banks. This morning, Scott Rector, who's a member of the New York Fed Board of Directors, released a white paper on CNBC this morning describing the trillions of dollars in commercial real estate loans that will come due over the next couple of years. He described it as a, quote, slow-moving train wreck, close quote, and for our regional banks. He went on to predict that it will force between a little over 500 banks, thereabouts, to either fail or consolidate. He also described what he termed as a doom loop where, similar to Silicon Valley Bank, when people lose confidence, when depositors lose confidence in the bank, they pull their money out and we end up in a bad situation. Now, I don't believe everything that I read or hear, but in Congress, we do tend to repeat it. And I just wanted to get a sense from you. I am seeing in my own city of Boston, we've got 20% vacancy rates in office space. We rely on that for a lot of the tax revenues for the city. But I'm just wondering your thoughts on that issue. Is there a systemic concern here, or is this isolated? And might lowering the interest rates help some of those banks? Because I hear from my developers in our area that no one's lending. So, yeah, crack at it.
Sure. So I haven't seen that report, so I can't comment on it, but I can comment on commercial real estate. So we've had a secular change in the economy, which has left office rentals in many places, office buildings. The demand for them is significantly lower, at least temporarily, and perhaps for a long time. And also the same is true for downtown, in some places, downtown retail that's associated with office workers. So it's a shock to the system, and we've known this for some time, and we've gone through the commercial banks in the United States, and so have the other regulators. We've done it jointly and identified the ones that have high concentration and are going to need to deal with that. And so we've been in contact with those banks and talking to them about how they're going to deal with this. How are they going to absorb these losses? Do they have enough capital? Do they have the liquidity? Do they have a plan to do this? And is it consistent with their lending practices and that kind of thing? So it's going to be something we work through over a period of years. I do think it's slow moving. I think that part of it is right. You ask about 500 banks. I have no idea about that number. But certainly there would be some banks, probably smaller ones, that have these high concentrations. It's not the very large banks. It's really a manageable thing at the large banks. So I think that's what it's going to be, and it's a serious problem, and more serious in some locations and jurisdictions and with some banks than others. But it's one we'll be working through, and I think that's how I would think about it.
Does the Silicon Valley Bank situation, Signature, the money moves so quickly in those cases. It was instantaneous now. The velocity of money moving out of those banks really, I think, in some ways contributed to their failures. Are we looking at anything technologically that might be able to address some of that or mitigate it?
Sure. So we also, after Silicon Valley Bank, we got in contact with and worked with financial institutions that had high concentrations of uninsured deposits, and many of them have greatly improved their liquidity position. So that's the thing that we're working on. Okay. As you probably know, we're also working on some liquidity rules, which will strengthen our framework of liquidity rules. But that's something we haven't proposed yet.
Let me ask you something off topic. So we know that Russia has about $300 billion in U.S. We've frozen assets. Russian assets of about $300 billion between U.S. and European banks. You want to comment on that? What I'd like to see is us give that to Ukraine, to be honest with you. I know that's a very simplistic idea, but I'm just wondering if there's any historic example that we could look to if Congress has to take the necessary steps to redirect that money to Ukraine so they can feed their people and fight that war.
This whole area of sanctions and foreign assets and things like that is really controlled and directed by the administration, by the elected branch of government. All we are is just a technical seat around, in the back row to help. We don't make those decisions, and I wouldn't comment.
I know you're big on history. I was just wondering if there was any examples out there that we might provide guidance to us.
Gentleman's time's expired. The gentleman from Texas, Mr. Williams, now recognized for 5 minutes.
Mr. Chairman, thank you for being here. When I'm back in my district in Texas, I'm constantly hearing concerns surrounding the fundamentally flawed Basel III. We've talked at length about that today, endgame proposal. These concerns are not only coming from my banking industry, but also from farmers, ranchers, small business owners who are concerned about how this proposal will impact the ability to access capital in the future. And to all of us, did it not raise alarms? And we've heard about the 97% today of public comments on this proposal, and they all came out negative. And Americans across all sectors are worried about the disastrous implications that will follow this proposal and have tried to make that known to banking regulators who continue to ignore them. It's time for federal regulators to take these concerns seriously and, quite frankly, just, I believe, start over. So I urge you and your colleagues to rethink the misguided policy and do what is best for American people, small business, Main Street America, and withdraw the Basel III proposal. Now, Chairman Powell, given the concerns raised by financial institutions, again, farmers, ranchers, et cetera, and other communities across the country, can you elaborate on how the Federal Reserve is responding to and addressing these comments that are mostly negative and request modification, delay, or complete withdrawal of the proposal of Basel?
Yes, I will. So we're in the process of reviewing the comments. They were quite voluminous. They were very detailed, a lot of data, a lot of analysis, and that's just what we wanted. So we got those, and now it's a lot. It's hundreds of them, and we're going through them, and we're just at the point where we're about to begin then turning to the question of what changes should we make to the proposal. We haven't made any decisions. We haven't really gotten to that stage yet, but remember, we only got the comments less than 2 months ago. So it's just, we're at that stage. So we're looking at it. As I mentioned, my own view is that there will be material and broad changes to the proposal as we go forward. And we haven't really made decisions yet, though. It's just a little bit early for that.
We're glad you're looking at it. I want to bring up the long-term debt proposal rule, which would require banks to issue enough long-term debt to cover capital losses. Now, Congress worked to pass legislation requiring the tailoring of regulations to the size of a financial institution. This is meant to protect banks of all sizes and allow for families and businesses in my district to have options to meet their lending needs. So the Fed's long-term debt proposal would undo any sort of regulatory tailoring and puts into place a new long-term debt issuance requirements on regional banks, which require these banks to issue long-term debt both at the parent holding company level and the IDI level. Now, these regional banks will face increased costs when they are already facing towering regulatory burdens from this administration, and those are the banks that people do business with. So, Mr. Chairman, do you believe that this proposal rule goes against the requirements of S2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act, and will you commit to exploring this issue further with your colleagues?
So we're committed to implementing 2155. We believe that the regulatory and regulation and supervision of banks needs to reflect their size and activities, and that's something we'll be considering as we go forward with this.
Okay. Short time I got left. Americans continue to feel the pain from runaway inflation created by the Biden administration as everyday costs continue to stay expensive. As you know, I'm in the car business, and inflation is just running rampant in my industry. And the irresponsible and partisan American Rescue Plan forced through Congress by Democrats only made inflation more of a problem. And now American families and businesses have been forced to deal with runaway inflation for 3 full years now, which has caused some major hardships. So quickly, the ARPA injected nearly $2 trillion of deficit spending to our already struggling economy. And how does this type of inflated spending combined with economic headwinds like supply chain shortages impact the economy? And doesn't this kind of reckless spending actually fuel the pressures of inflation?
I think there are a lot of causes of the inflation we've seen. we saw this inflation everywhere in the world. So the reopening, really the reopening of the economy after with very strong demand and constrained supply, you saw inflation in all the advanced economies. It was a little sharper here at the beginning. I think there's a role for monetary policy in that. There's a role for fiscal policy. There's a role for the pandemic, a starring role for the pandemic. You know, our job is to deal with it, and that's what we've been doing.
Well, thank you for always keeping small business in Main Street America in your calculations. And with that, Mr. Chairman, I yield back.
Gentleman yields back. Gentleman from California, Mr. Sherman's recognized for 5 minutes.
Mr. Chairman, I want to thank you for recognizing in your opening statement the importance of immigrants in keeping costs down. And I want to thank you and the administration for what has been an excellent 2023 economic report. We've got 3.1% economic growth, by far the best in the developed world. Headline inflation, 2.4%. And that's not a little blip, you know, a 1 month number. That's for the whole of 2023 and compares very favorably with the pre-pandemic portion of the Trump administration when we had inflation of 3.5%. My goal here is to convince you to cut more and sooner because for a number of reasons. The first is that I know, you know, if you ask a constituent, they want zero inflation and zero unemployment. You know that we can't have that and have concluded that the economy works best with a 2% inflation rate target. But I've looked at the history of that 2% number. It seems to come from Auckland from the 1980s. And there's a lot of arguments that your target should be just a little bit higher. Larry Summers recently produced a study arguing that the cost of money is part of the cost of living. So we have this weird paradox where you're trying to keep the cost of groceries down by raising interest rates. But as the ranking member points out, the big issue is housing. And your measure of inflation seems to treat all Americans as renters, even though 2/3 are homeowners. And so when interest rates go up, that's an increase in the cost of living for anyone with an adjustable rate mortgage, anybody looking to buy a house, anybody with a home equity loan. Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis that argues that your target rate in the economy would work better if we had a slightly higher target than 2%?
Not really, no. What's happened is, you pointed out New Zealand, but what's happened is that 2% has become the global standard. It's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. You know, we're at 2.4% right now, headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%. Let's look at Basel. There's nothing free here. If the standards are too high, we lose economic growth. If they're too low, we have bailouts and bankruptcies. But I think everybody agrees that the standard should be well crafted. You've got a system where everybody drafting this is well dressed and focused on Wall Street. And you've got Basel rules that discriminate against Main Street and for Wall Street. I'll give you some examples. 65 basis, it's 65% if you're a publicly traded company and make a loan to a publicly traded company. You make a loan to CalPERS, they're not publicly traded, without objection, like to put in their article into the record. And so they're in effect going to have a tougher time getting a loan. The local pizzeria is going to have a tougher time getting a loan. You've got in Basel III ignoring mortgage insurance, which obviously makes the loan more prudentially sound for the bank and is very necessary for first-time home buyers. And you've got a system where if you make investments in long-term bonds on Wall Street and you put them in the hold to maturity category, you don't have to recognize the losses and mark to market. So I hope you'll look at these in terms of the competition between Wayne Street and Wall Street for bank loans. Finally, we go to clean energy investment. Can I count on you to personally look at the paradox where Basel III treats clean energy tax credits much more harshly than low-income housing tax credits for no ascertainable reason?
Yes.
Thank you.
Gentleman's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Well, thank you, Mr. Chairman. Mr. Powell, thank you for being here today. I'm concerned with the small dollar credit for businesses. As a former business owner for over 20 years, I can attest that as the small dollar business credit becomes more expensive and less convenient, businesses are going to turn to credit cards and other alternative financing for business purchases. These inevitably result in even higher costs, which goes down to the consumer, which means that they're going to pay more for the services or the products. But in February of this year, total credit card debt reached a record of $1.7 trillion. According to Intuit's Small Business Index annual report, average monthly credit card balances were 27% higher in 2023 than they were in 2019. What do you view as the driving force behind these record high levels of credit card debt?
Part of it would be growth in the economy. So that'll be part of it, just that it's a bigger economy and a bigger number. I'm not sure what that is. As you know, people had lots of extra cash during the pandemic from forced savings. They've spent that down. Now they're borrowing. I'm not sure.
So if there was a rule to force banks to tighten lending, do you think the rule would drive businesses and consumers to alternative forms of credit?
I do. I think, if you raise lending costs for banks, then at the margin that will make non-bank lenders, they'll get some of that business.
And if it becomes more complex or less convenient, then businesses will turn to these alternative forms like credit card. I can tell you that from experience. Yes. Well, I've called for the withdrawal of the Basel III endgame proposal entirely. Will you commit to an analysis of how bank capital proposals like Basel affect small business credit access and the small dollar lending before finalizing such proposals?
I commit to that. Let me look into that. I don't want to make a commitment that I'll undertake some big study, but we'll look at the issue.
Do you feel it's important that we do have an understanding the effect it's going to have on small businesses, the backbone? It's the bloodline of our
and they
economy.
create the jobs. That's
Yes.
right. I do agree. Yeah.
Okay. The chairman asked you for your thoughts on withdrawing or reproposing the Basel III endgame proposal. Have you specifically discussed withdrawing the proposal with Vice Chairman Michael Barr or the other governors?
So I don't want to get into our internal, doings, but I will say that I understand it is a live option. Again, we're not at a stage of being able to even have that discussion yet because we've got to decide first what changes do we think are appropriate, and that'll take a little time. And then the question will be reproposal. What I said is when we get to that point, if reproposal is the right thing to do, we're not going to hesitate at all. It's a perfectly live option.
All right. In the current environment we have in politics in this country, there's not a lot that you find bipartisan agreement on, but I think you could find some agreement in withdrawing that proposal. Can you explain the importance of broad consensus at the Fed on proposals like B3E? Are you concerned with recent trends of disagreement among board members related to major proposals?
So I think we're going to get to broad consensus at the Fed. I do. I think it's very important. This has been our culture that we try to find common ground, and we've been able to do that in the regulatory space, and I expect we will be here as well. And I'm committed to that.
Could it be that we're seeing this level of disagreement because of extreme measures that are being taken now that may not have been taken in the past? I mean, a total difference of opinion and understanding and philosophy regarding a free market economy.
I won't speculate, but I will point out that, 4 of the 7 governors during the open board meeting at which we put it out for comment expressed real concerns, very specific concerns about the proposal and said we would look at the comments when they came in, and that's what we're doing.
All right. Do you feel that they have validity in their concerns?
I was one of the 4, so yes.
With the few seconds I have remaining, there's a recent report of FinCEN working with financial institutions to query legal purchases made by American citizens. Has the Federal Reserve been instructed within the past 3 years by Treasury or anyone else to search Americans' legal transactions?
Not that I know of, no.
Okay, thank you. I yield back.
Gentleman from Illinois, Mr. Foster is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for being here. As Ben remarked, there's a near-term emergency to get the 60 billion in military assistance to Ukraine. And separate from that, there remains a longer-term need for reconstruction assistance to Ukraine, which the World Bank estimates is somewhere north of $400 billion. Now, at the start of the Russian invasion, the free democracies of the world froze roughly $300 billion in Russian currency assets, primarily at European banks and financial institutions. And the Biden administration and many of our allies have recently taken the stance that those assets should be leveraged somehow to provide reconstruction resources to Ukraine. I support this concept, and I believe that additional action should be taken to ensure that we hold Russia accountable. But there are real concerns on the impact that this might have on central banking system, on the primacy of the dollar, the euro, and so on. And so my question is, have you seen just the act of freezing these assets and not seizing them, but simply freezing them? Have you seen deleterious effects on the primacy of the dollar, the confidence in the central banking system? Is there any visible downside from the act of freezing that's visible so far in the 2 years since we've done it?
I can't point to any. I can't point to any.
Okay, so that's an interesting observation when we think of taking the additional step of actually seizing them, that at least so far, because, to my mind, having them frozen is as violent as and as violent as seizing them outright. And so that's interesting that so far we haven't seen that. Now, in terms of the Basel III and so on, there is there's a frustration I've had over the fact that directionally the effects of these are clear, but the magnitude of effects are not. For example, if you talk about the effect on the prices seen by derivative end users of increased capital requirement. Directionally, it's clear. If you raise capital requirements, banks will withdraw from these markets to some extent. Other players will step in partly and take up part of the slack, and the spreads will increase and so on. Is the data that you've collected enough for you to actually estimate the magnitude of these effects instead of simply the direction?
I think it's really hard to get down to the micro level and try to assess that, because you're right, there would be multiple effects. But you do know that you know the direction, you know what the sign is.
That's right. But if you can avoid financial crises with a microscopic increase in prices seen by end users, that's one thing. If it's a very large difference in the price, so that the magnitude matters a lot when you're doing these balancing things. And a lot of it depends on, actually, you need a model for how the different market players will react. And is that really not going to be in the scope of the analysis that you anticipate from the quantitative?
I believe we have done some work on that. I think the banks and other participants have done work on that as well and come up with a range of answers. But this is there are just an awful lot of variables in these equations. So it's hard to say with any confidence. That's why it's hard to, the job of deciding the precise level of appropriate capital is a hard one.
Yeah. And now with 10 years, we've had 2 major crises with both a fiscal and a monetary response. Are there the lessons that you can learn now that, I believe, and it seems like your testimony indicates that we're kind of approaching back to normal now. And we've seen in the crisis of 15 years ago, we saw what many people thought was an inadequate fiscal response, that the fiscal response was, less than half of the output gap. And we limited by political will to do things. And then, of course, you were limited by the zero bound in what you could do for most of a decade. And we had a long recovery. And the comparison, to the COVID recovery has been very sharp, and it's quite remarkably put us right back on that track. Are there any lessons that you've sort of drawn about the importance of the getting the right balance of fiscal and monetary response to these shocks?
So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now, we'll be looking back going and saying, we've learned so much more. So I think the pandemic is still writing the story of our economy right now. And we should just be prepared to be surprised with the next chapter, as we were with 2023, the very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
Gentleman's time has expired. We'll now go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III endgame. I think Congressman Barr kind of nailed the thought process. I do hope you'll kind of withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to address one of the other practices by the Federal Reserve, and it's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risk actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our country wouldn't pay a price for this market distortion by the Fed in two ways. First, they're unable to obtain loans at competitive rates because the money's sucked out of the market. Frankly, a lot of them don't even have access to lending except through bank capital. So it forces them into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy to the undistorted free market economy it's supposed to have. The alternative is you could simply raise requirements. We see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. Banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed, but they don't have to buy. They don't even have to put it on their own balance sheets in the same way. They've got immediate liquidity with Fed overnight account. So I don't see how that's different than what they could already do.
What I was going to say was, banks can earn a much bigger spread by lending to corporates. So their incentive to lend is the same as it always was. This doesn't affect that. Really, it's they have a cost of funds and they have the ability to have reserves, but that's not going to. They're not earning a profit on that. So, or a big one. They can earn a much bigger profit by lending to small corporates.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that the Federal Reserve operated at a $114.3 billion loss in 2023 and currently is carrying a $133 billion loss on its balance sheet this year. So it's, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, we've, for many years during the QE large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been, giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And if we retained all the earnings we have, then it wouldn't be.
All right, I'm taking a, guys, I'm going to pause it real quick. Let me know in the chat. Should I talk a little bit about Palantir for like 10 minutes? Then we'll go back to this. He's not saying anything that interesting anymore. The good questions are gone. Let me know. If not, I'll keep playing it. I'll see whatever the chat says, and then we'll keep going. Palantir right now at 26.45.
Be a problem, but we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need a staff.
All right, we are taking a little break to talk about Palantir. Ladies and gentlemen, Palantir right now is at $26.40 freaking cents. Like, I don't think anyone woke up today on Wednesday, March 6th and was like, yeah, Palantir will be up 10%, cracking through $26 and just doing what it's doing right now. The reason this is happening for those that are just joining is because of that Titan contract. That Titan contract was incredibly exciting to the street. Not only are we having a good day in the macro and JPow's not really saying anything that's getting the market upset, but that Titan contract, I think, is creating institutional volume. 125 million shares. It's not like the 400 million we saw post earnings, but a 10% increase. I don't think that's retail. I do not think that's retail. I don't think retail is moving this thing up 10%. There's 2 billion shares outstanding. There has to be some level of institutional exposure. Some institutions are waking up and they're like, why don't we have exposure to Palantir? $50 billion market cap, Nvidia's 2 trillion, Microsoft's 3 trillion, Tesla's at 600 billion. All of these are great AI plays. This little dinky company at 50 billion just got a $178 million contract from the government for advanced DoD, Army, AI, machine learning, intelligence applications. Maybe 57 billion is kind of cheap. And as a result of that, there you go. Palantir right now at 26.44. Now, a couple things I want to say on Palantir's run right now. The S&P 500 is not priced in my opinion. Why? Because I think the reason we didn't get into the S&P 500 is because we have the lowest institutional float out of all 500 companies. We would have the second lowest if we got accepted. So I think the S&P committee was like, okay, we need more institutional owners before we officially let these guys in, which means it's not priced in. Toots have not bought up the stock yet. I know we went from 38% to 40%, but Snowflake's at 65%. So I think we have another 25% to go at least of institutional ownership, which is going to push so much pressure on this damn stock, dude. Like when those many institutions get in, 25% increase, it's going to be magnificent. On top of that, the Titan contract is now starting in waves. So we got the first part of it today, and we're probably going to many more phases over the next couple of years, probably another one later this year. So that'll be more top line revenue. And then Q1 earnings, I think, look, I don't know if it's going to be a monster quarter, but in the next couple of quarters, we're going to get a monster quarter. Why? Because we are having AIPCon tomorrow. For those that missed that news, AIPCon will be happening tomorrow. I'll be streaming it live, and we've got a ton of new customers that are presenting. What does that mean? That means the market, those institutional clients and hedge funds and investment firms that are, thinking about Palantir, on the edge of Palantir, when they see OpenAI present tomorrow, when they see General Mills, when they see Lowe's, many of them probably got invited to the conference. When they see, even if OpenAI is not on the main stage, if they're doing like a mini little booth with Palantir, they're going to be like, why the hell are we paying $80 billion for OpenAI on the private markets, which is the current valuation? I think it's like $88 billion. They're doing $2 billion in revenue. Palantir is going to do $2.6 billion in revenue. and Palantir is only worth 50 billion. I mean, at some point, there's going to be an argument from institutional investors that are like, this is stupid. Why do we not have Palantir in the portfolio? 850 boot camps, more boot camps happening, S&P inclusion not priced in. All of that to say, I think this bad boy can run to 30 if Q1 earnings are very, very good. Now, could we get to 30 before that? Sure, that would be a little bit, maybe a little overstretched if we run to 30 before Q1 earnings. But if we have a dominant Q1 earnings in May, we're probably heading past 30 because then S&P 500 is inevitable. Institutions realize, oh my God, they missed the boat. This thing's at $26. They're going to be like, all right, fuck it, we'll just buy. And there's likely not going to be that much sell side pressure either because why? It's kind of like Nvda. Why would you sell it if you know they're growing and their numbers are good, right? Like there's going to be some traders that take profits like what's happening today, but the far majority of people are not selling Palantir today. That's why it's up 11%. Because even people that probably bought in at 21, 22, they're like, well, wait a second. I bought this for a trade, but I mean, if they're getting $200 million from the government to do AI, maybe they're the real deal. And then, there you go. That's why Palantir is up 11%. I definitely do think it's going to be interesting to see if we hold 26.44. That's going to be the exciting part. If we close today above $26, I mean, this is just going to be one of the most exciting days for Palantir. We have not closed above $26, I believe, since September of 2021. So it's been a very long time since we've been at these levels. And 26.48 right now, it looks like we're trying to get even past those levels. It would be great if we could hold that. Now, in terms of the wall, there's not a big wall. So I'm looking at this wall. My data is not perfect, but it's decent data. Robinhood, by the way, at 1650, Bitcoin 66,945. Let me show you guys this right here. So there was a pretty big wall. You see the red on the screen? There was a gigantic wall at $27.30. There were 320,000 shares. You see how that wall kind of dissipated? Like you would have noticed there was a big, like just wall, like a big line you couldn't get through. You see how it's kind of shrunk and now it's like a V shape? If Palantir has enough buyers, we're going to 27 today. If we have enough buyers. Now, do we have enough buyers? Time will tell, right? We'll see over the next few hours if there's enough. There's 37,000 shares at 26.71. That's nothing for Palantir. I mean, a whale can eat that up really quickly. There's a ton of new buyers coming in. I don't think we're going back to 23 today. 24.90 maybe if there's some massive rug pull, but it does not look like that's happening, dude. This is a healthy 11% gain. Year to date, folks, we are up 56% on Palantir. And it's pretty exciting to see how this is happening. So, you know what? Star Buccaneer says what V stands for. You know what it doesn't stand for? It doesn't stand for Virgin. Because, or no, it actually does stand for Virgin because Palantir is not fucking us. But I messed up a little bit on the joke. It would have been better if I got it right the first time. But it does stand for Virgin because we're not getting fucked by Palantir. We are virgins today. Palantir 26.42. Now, back in freaking 2022, when Palantir got a deal like this and the stock would go from $8 to $7.40, we weren't virgins. We were getting effed. Excuse my French, but we were getting effed by Palantir. And today the market's like, you know what? It's time to keep buying up this stock. It's time to keep buying up this stock. Parity Bit says, I just want Palantir to move. I'll trim at 30 or buy at 20, but this mid-range is waffling. So I have the opposite opinion. I would rather it consolidate in the middle of the range. Like I would love if it gets to 30. That would be awesome, but that would probably be a little overstretched before Q1. And if it goes to 20, I mean, look, I would buy the dip, but I wouldn't be the happiest because you want to see this thing like actually make a leg up. And the next leg up from that $16 purgatory we were in is probably 23 to 25. Probably 23 to 25. And right now we're at 26.48. This is a healthy margin of safety too. Before to get to 25, we would have to drop. How much would we have to drop? So 26.49 minus 25 divided by 26.49. Hold on, 26.49 minus 25 divided by 26.49. We would have to drop 5.6%. I mean, I don't know, dude. A 5% drop, it's possible, but you would just need a big group of sellers that just crush this thing. And it's like stabilizing at this level. So if we drop 11%, we'll be back at 24. If we drop at 5.6%, we'll be back at 25, which still is amazing. We'll still be up 6% in the day, even if like it's so funny. We're saying, oh, if we get to 25, it'll be sad. It's like, dude, we were stuck at 23 for the past 3 weeks. If we got to 25, that's amazing. Like this morning when I saw 24.11, I was like, oh, that's great. We're back at 24. Then we tweeted 25.80. I was like, oh, that's amazing. Then we saw 26.05. We were like, oh, this is really good. We're in the 26s. And now we actually might make a run at $27. We actually might make a run at $27. KQ Forever says, Amit is the master of virgin jokes. It is what it is. It is what it is. Look, this is just, it's an incredible to see that this is happening. Robinhood as well. This is a company I'm heavy on. 1656 today. They're having a pretty good day. So that's doing well. Dell Technologies 120, Berkshire Hathaway 406, MicroStrategy up 19%, Bitcoin 66,934. That's really good. Unbelievable, guys. Snowflake is down 1.29%. I want to highlight this for a second. Snowflake being down today, it's not just a question of them being down after earnings. It speaks to the market kind of reacting to the divergence between Palantir and Snowflake. Snowflake should not be down because the entire market's up. The only thing that's down today is like Tesla, Apple, and Google because, I mean, you know, we all know they're struggling with stuff. The S&P is up 1%. It's not easy to move the S&P up 1%. Snowflake should be up at least like 0.45%. It's down 1.2%. I think the street is looking at their Snowflake shares and they're like, why the fuck do we own shares in a company that can't even have a CEO that like is there for the long term? And there's no shade against Frank Slootman. He's getting older. He wants to retire. That's fine. But Alex Karp's not going anywhere. Alex Karp has the enthusiasm as a 22-year-old kid building a startup when he talks, dude. And so it's really interesting to see this divergence between Snowflake and Palantir right now, because the market's basically saying, hey, we don't want Snowflake shares anymore. We want Palantir shares. We want, you know, a company that's innovative and that's exciting. Here's the AIPCon thumbnail on YouTube. Look at this. This will be tomorrow. I'll be here live at 1 p.m. I believe this will happen. There's a little bit of a logo here about space and the sky. Look, oh, wow. We got some words. Here we go. Compressing time and space. That's the headline for Palantir's AIPCon. Compressing time and space. Tomorrow is going to be an exciting AIPCon, dude. Tomorrow is going to be exciting. If they're doing compressing time and space, we're going to see some wild shit, dude. We are going to see, and that's, you know why this is really important? Because when the market sees some really dope presentations tomorrow, they're also going to be like, damn it, this company is literally going outer space, dude. They're literally going to the moon. Compressing time and space, the space-time continuum, Back to the Future. There might be some crazy, crazy demos that Palantir shows tomorrow. Just like really cool shit as a software company. And I think the market's also thinking, well, maybe we get ahead of it before it actually shows up. So that'll be fun. That'll be fun. Are you streaming AIP? Yes, I'll be streaming AIP. I will indeed be streaming AIP. So I'll be here. I'll be here tomorrow. It'll be fun. Robin at 1651, SoFi 753. SoFi's up 3.5%. CrowdStrike up 12%. Bitcoin 66,946. S&P at 511. Again, Palantir at 2642. Edmund says, can you imagine Sam Altman presenting? Yeah, that would be funny. I don't think Sam Altman's presenting. That's probably not happening. But if he does, that'd be really exciting. Now, and we'll see, you know, they have a partnership with OpenAI, so we'll see what they're trying to say. John C says, stop dissing Snow. What I'm saying about Snowflake, I really don't want it to be interpreted as a diss against Snowflake, because I think they're sandbagging their numbers. I think being down 30% is probably ridiculous. They don't deserve to be down 30%. The problem is Snowflake has not captured the excitement of the market. Snowflake is now down. I mean, let's pull up their numbers. About 20% since they went public. And the reason this is bad is because this stock went public during the ZIRP era, the zero interest rate phenomenon. Now, look, they have good numbers, but people forget Snowflake's not, they're down 30% all time. Snowflake's not profitable. And Snowflake's growth has declined for the past 4 years. So this idea that Snowflake and Palantir are just going to or Snowflake's going to just always be better than Palantir, I don't know, dude. I don't know if that's necessarily going to be the case. It's going to be hard to kind of imagine seeing them, just do what they have to do. And I think, again, when it comes to excitement, Palantir's AIPCon is oversubscribed. That was in the title of the PR. Snowflake's not having some conference where people are begging to get tickets to. Like, it's just not, they're not, it's like, have you guys seen Mean Girls, where one of the girls is like, you can't sit with us? Snowflake can't sit with us. Okay. Like, she can't sit with us. We're the cool kids. We're in the cool club. We were made fun of 2 years ago. We weren't the cool kids. And then we worked our asses up to be the most popular kids in school. And now everyone wants to sit with us, and Snowflake just can't sit with us. They can't sit with us. So it's just, I don't know, dude. It's one of those things where if you bet on Snowflake, if that was your big bet, they're probably undervalued right now. They're probably sandbagging guidance. But I would say Palantir, who has finally overtaken Snowflake's market cap, Snowflake at a 54 billion, Palantir at 57 billion. Palantir is really the show in town that people care about. And that's why Wedbush had a price target of $30. Apparently, Bank of America, Mariana reinstated a price target of 28. She raised it from 24 to 28. Someone told me that on Twitter. I haven't gotten confirmation from Bank of America Securities. If anyone has that note, please let me know. But I'm pretty sure she tends to raise price targets on Palantir specifically when they get new deals. And so this deal was a big one. So Bank of America might have done that. So that's very exciting. Golden Eagle says, what about next week's CPI? Can Palantir fall on that? Look, the thing about CPI next week is that the whole market can fall, but I don't think CPI, even if it's a little hotter than what the market thinks, like the market probably wants 2.9, it's probably going to come in at 3, or maybe goes up to 3.2. I don't think that's going to be the case. Probably lowest is at 3. I don't think the market cares anymore. Guys, Nvidia is at almost $900. Nvidia right now, 888. Okay, so Nvidia's $12 from $900. I don't think the market gives a shit about inflation anymore. I just don't. I think the market has realized that inflation is eventually going to fall down, even if it doesn't fall down soon. We know it's going to be hit. Even the politicians, outside of asking Jay Powell about diversity and climate change, they at least got to ask him about the lagging data. So even the politicians know that the Fed's data is lagging. The market knows that. And AI is the catalyst. AI is increasing productivity, increasing margins, increasing revenue, decreasing costs. If that's the case, inflation will eventually become deflation with AI. China's exporting deflation. Like, there's so many counter narratives. This is not June of 2022. It's just, we're in a brave new world. And I think that the market has decided 2024, they want to make it a bull market. Now, could we get a pullback? Of course. Could we get yesterday we got a red day, but that was like a red day for no reason. It was a red day just for the hell of it. It's kind of like the market was like, all right, we deserve to have a red day. We're not seeing anything structural right now. And that's what Jay Powell's saying in Congress. Every time they ask him something, he's like, look, like, we're looking at the data. The data's fine. Economy's growing. We'll cut rates when we think, we need to cut rates, and that's it. And so the market's like, all right, so Jay Powell's not saying anything that interesting either. And so there we go. That's why we got Palantir at 26.36 right now. And again, I just don't think CPI is going to be some ridiculous report that like really tanks the market in a substantial way. I think the market has come to the conclusion that AI is real, and the bears, they have to get a better bear argument. I don't think they can continue to say it's inflation now. It's like there's got to be some better stuff out here if you're trying to make a real big case against Palantir. CleanSpark is up 10%. Yeah, the whole market's getting a little bit of a momentum. Obviously, Bitcoin rallying to 67. That's helped a lot. HPE is up 6%. Robinhood up 3.3%. Coinbase up 8.5%. Crypto companies are all green on the day. CleanSpark's up 10%. Marathon's up 3%. Riot's up 1%. MicroStrategy's up 19%. Bitfarm's up 4%. And obviously Ethereum at 3,800. Bitcoin 66,850 today. Now we got to see, can Palantir make the run to 2650? There is a little bit of sell side pressure there, so we'll probably have some resistance. But we got to see if we can actually get it there. Priority Bit says the market going down on inflation is ridiculous anyway. In the long run, inflation also inflates stock prices. The entire balance sheet, bottom line included, will inflate in the long run. I agree with that. I also think that, if we do get a dip because of temporary inflation, that's a great dip. Like if we get a really nasty 5% decline because of one hot CPI report, the Fed's not raising rates. I've seen some bears on CNBC over the past couple of days say they think the Fed's raising rates. Like, you can be bearish, but you can't be stupid. And the Fed's not raising any fucking, we know that's not happening. So if that's not happening, a dip on what we know is inevitably going to come to reduce the trillions of interest payments we're making on the trillions of debt we have is a rate cut, which I think takes the stock market to a different level. Means that a dip actually would, it would be a nice buy the dip opportunity, I think, for a lot of people. So I think either way, we're going to be all right going into the next month. Also, a quick piece of data. When the S&P finishes 5% higher in February, which tends to not happen. February is usually a horrible month for the stock market. 5 out of 6 times the next month is higher. And on average, the entire market is 13% higher for the rest of the year. So history is on our side that February being a good month, signals that March probably is going to be a good month and the rest of the market is going to have a good month, a good year as well. Edmund says he DM'd me Mariana's updated Palantir report. Thank you so much, Edmund. All right, let's pull that up. This is another reason I love this community, dude. We all are fucking helping each other out. We're all crowdsourcing information. Like, all of us are here, like, literally making sure we all make some fucking money, dude, by investing in shit before the big guys get it. Before the big guys get it. I'll tweet it out right now. Let me tweet it out right now before I read it so everyone else can have access to it. So let me save the image. Okay, let me tweet it, and then we'll read through it. Palantir Bank of America upgrade to $28. Okay, let me tweet this out. This is, and again, that's another reason the street's probably buying it up. Mariana's a pretty important analyst. She's one of the main ones covering the stock, so street's probably excited about that as well. Okay, let me do a screenshot because my downloads weren't saving. And there you go. Look at the title of what she said. Introducing the software prime. Oh my God, dude. She's excited. And Mariana was one of the only institutional analysts rooting for us at $6, dude. You could tell on those earnings calls she liked CARP. You could tell. She was like a retail investor, dude. She saw CARP and she was like, this guy's different. This guy's cool. This guy's dope. And I'm taking a bet on this guy. Okay. Here we go. Let me just tweet this out. Mariana. All right. So Palantir Bank of America price target upgrade to $28. Okay. Palantir Bank of America Mariana raises. Okay, here we go. Okay, so if you want to see it on my Twitter, it's now live on the Twitter. Okay, here we go. Let's read through it. The AI prime emerges in Greek mythos. Wow, she's starting her note up with literally referencing Greek mythology, dude. That's insane. That's absolutely insane. Okay, in Greek mythos, the War of Titans lasted 10 years and ended with Olympians, a younger generation of gods, taking the helm. Dude, she is literally speaking like CARP on this price target. This is insanity. 8 years after Palantir sued the U.S. Army and ultimately beat out Raytheon for a DGCSA contract, I didn't even know that, we find it fitting Palantir has once again won a battle against the old guard and been named Prime on Titan. This deserves a cowbell. See the award and program details below. In our view, the implications of this win stretch beyond the initial $178 million 2-year work scope. We see the win cementing Palantir as the AI prime in the world of defense and anticipate further penetration opportunities as the heritage defense companies acknowledge the advantages of outsourcing more software capabilities. Given the win and strong signal it sends to procurement and how it's evolving, we reiterate our buy and increase our price target to 28 from 24. Dude, like, I want to cry right now. Like, this is just, this is poetic. Is this not poetic that we won a Titan contract and Mariana is using Alex Karp philosophical starts to these shareholder letters by philosophically starting a price target upgrade from a Wall Street firm? Like, you can't ask for more, dude. Something like this is one of those things where you just sit back and you're like, thank you. Like, this is just incredible. Absolutely incredible. Titan ushers in a new era of procurement. This is the first time a software company has been named a prime on a hardware production program. This is what we talked about early in the morning, which we see as a signal the DoD is embracing change. The team assembled by Palantir is a mix of traditional partners and non-traditional partners like Anduril. The approach is unique in a realization of Palantir's strategy to develop cutting-edge AI-enabled capabilities, which are present from initial development to final product delivery. A picture of the development of JADC2 capabilities. JADC2 is the DoD's effort to connect individual networks of services like Air Force, Army, Marine Corps, Navy, and Space Force into a single network. Realizing this vision is a critical priority for the DoD, a key to the U.S. maintaining an enduring advantage against peer threats, i.e. all the geopolitical problems we're having across the world. At CES 2023, Palantir showcased the demo Titan unit, which used their software as a digital backbone and how the software is capable of connecting sensors, comms, and vehicles across disparate systems. While Palantir was not initially selected for the consortium to develop the initial digital backbone under the ABMS2 of Palantir's Titan partners, Lockheed Martin and other companies were. We see it likely that Palantir will be more involved in the development, either through their partner relationships to penetrate the program, if Titan proves to be as successful as Project Maven, which is a $229 million contract Palantir got when Google decided not to get the contract back in 2022. There you go. There you go on Palantir. Mariana believes EPS in 2024 will be 30 cents. The PE will be 82. EV to EBITDA will be 56.9, and free cash flow yield will be 1.7%. And that is how she comes up with a $28 price target. There it is. There it is. I'm going to put this in the chat for anyone that wants to read it. So if you want to read it yourself, this is the tweet, and you can download that and read the report. This is crazy, dude. This is pretty crazy. Palantir now 26.27. Even if we fall below 26, guys, the fact that this is happening, the fact that the street is starting to realize what's going on. And now look, it gets harder to buy in because let's say Palantir falls to 24.85. 24.85 2 days ago was like, oh my God, 24.85. Like we're getting close to 25. 24.85 today is like, ew, 24.85. Like that's like, ew. And the dip buyers are like, oh my God, 24.85. We can finally buy before we get back to the 27. And all of us longs are like, well, 24.85, like that we're past that. Now we're at the 26 stage. And so now there's a push and pull over the psychology over when do people buy the stock, when do people sell the stock. And the fun thing about, the cult that Palantir has created, and the, the community that's around this is that it's funny. A lot of Wall Street thinks that retail is dumb money and that we're in this cultish stock and, they have their whole ideological perspective on it. The problem is Wall Street thinks like Palantir is GameStop, AMC cult type of communities. We're not GameStop. We're not AMC, dude. We are one of the most sophisticated retail investing communities on the fucking planet. Like the amount of due diligence we've done about this company is astronomical. I would say it's better than the due diligence the Tesla community did back then. Now Tesla obviously 20x, and so you got to give all their credit because they got something that 20x before 20x. So all the credit is there. But in terms of sophistication and non-delusion, I think we're not as delusional as some of these Tesla guys. I mean, I love the Tesla community. I have Tesla, but I really do think we're objective here. We say when Palantir's not growing enough. We bang on the table when we say, hey, get your shit together. For 2 years, we criticized these guys that they couldn't sell their fucking software. Peter Thiel wrote a whole book, 0 to 1, saying that distribution matters more than product, and Palantir couldn't figure out distribution. So we were very critical. We knew what was wrong with the company at $6. We just knew one simple thing. Just like the Tesla bulls knew that it's really hard to make an EV, but once you do, things can take off. We knew it's really hard to sell, but once you figure out sales, it's way easier than figuring out product. Product is the hard part. Sales is the easy part. Once you figure that out, it's just about scale. It's literally just about getting into escape velocity. And that's what's happened now. So I think Wall Street, for them to consider us dumb money is not a good idea. I mean, you could say that for other random companies out there, AMC, GameStop, not with Palantir. Not when people are sitting on a 4x buying the shit at $6, dude. I mean, we're at Palantir all time now. Let's see this Palantir all time. Palantir stock all time. Palantir is up 186%. And again, if you got in the lows, you're sitting on a 4-bagger. You're sitting on a 4-bagger, dude. So, I mean, I don't know if this is dumb money. I think this is money that was, look at this range. Look at this. We last time we were at 26, August 2021. August 27, 2021, it's September 2021, we were at 26. We fell all the way right here to $8 starting in May of 2022. And from May of 2022 all the way until May of 2023, that was the first time they reported GAAP profitability. So basically 12 months straight, we had to deal with being from $7 to $9. And that was when most of retail was doubling down and realizing that, hey, this thing's not slowing down anytime soon, dude. That if they just figure out this sales problem, they're going to scale. The one also interesting thing about a tech company, and I said this in the morning, is that, I was talking about Facebook. Facebook has billions of users, but they're number 2 on the App Store in the United States because they keep getting more. Technology is unlimited. Jeff Mueller right there, 9,600 shares. That's amazing. Congratulations to you. Lowest purchase I made was at $5.99. Absolutely incredible. The beautiful thing about technology is it scales, dude. I mean, think about YouTube. Think about this channel, right? I mean, like, I remember streaming to 70 people, being super excited about Palantir. Now, in combination with Twitter, we're at 4,000 here today, and it's because technology is unlimited. Technology scales. If you perfect your craft, which for me, in the context of what I'm doing is content creation, there's an infinite amount of people that can discover who you are, given the scale of YouTube that is 2 billion users, and that potentially can care about your content. With Palantir, there are an infinite amount of enterprises and government entities, because Palantir is never going to get all of them, that need an operating system for their data, that need an analytical framework, that need simultaneous deployment of their software, i.e. Apollo, that need to integrate LLMs so that they actually make sense in their organization, that need to protect themselves, especially if they're on the Baltic states, from getting invaded by Russia. Like, there's an infinite amount of these guys. There is no stopping how big Palantir can grow, how fast they can grow. The only thing stopping them is themselves. And we're looking at a company right now that's trying to go as fast as they can and get the job done, hosting their 3rd AIPCon in less than a year. Their first AIPCon was June 2023. Dude, it's not even June 2024. We're on the 3rd conference. Like an AIP came out 5 months after ChatGPT. So the level of innovation Palantir needed to have to be able to get the product out, then to be able to get clients using it, then for it to be able to show up in their numbers, which it did in the last quarter. That's why the stock is up. And then to host 3 conferences on it to get the buzz out about this product. I mean, dude, they didn't have to acquire a single company to do this shit. They just had to innovate and to be them. And that's what they're doing right now. And that's what we have for Palantir. So really, 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 really exciting to see what's going on in Palantir. And we'll just see how they can keep doing their thing, how they can keep going. 2635, we got Robin at 1647, Bitcoin 66,984, entire market, S&P 500 also doing well, up 0.87%, and then QQQ here at 441. All right, I think we got like 15 minutes left of JPal, so let's hear his last 15 minutes and see if he's saying anything interesting, and that's the last of it today. He'll be done by 1 p.m. It's 12:45. So last 15 minutes of JPal, and then we'll be done. Here we go.
Change that recommended change.
Could you discuss why you feel it is necessary to include new requirements around operational risk in Basel III in light of recent claims that it will significantly increase the cost of or prevent banks from offering altogether necessary services such as underwriting, investment advisory, or insurance?
That is one of the concerns that's been articulated about the proposed changes to operating risk. We take those concerns seriously. As I mentioned, we're in the middle of looking at these things, and then we'll soon, in the process of turning to the question of what changes to make.
Well, I just would underscore the sense of urgency, because the longer there's uncertainty in the market, it creates really negative effects to end users, which are all of our constituents who are looking to see these costs come down. Let me shift. This Congress, under the leadership of Ranking Member Waters and former CBC Chair Joyce Beatty, I've made it a focus of my efforts to educate my colleagues and the public at large on the far-reaching benefits of increased diversity in the workplace, in our boardrooms, and in society as a whole. Despite the efforts by some on the other side to take away the very tools of economic opportunity that create inclusive work environments and improve performance, there has been a really misguided assault on everything from diversity, equity, and inclusion to other programs following the aftermath of the Supreme Court's ruling on affirmative action. So Chairman Powell, as you know, your Office of Minority and Women Inclusion has a focus on this. So as we anticipate the upcoming release of your annual report on inclusion, would you be able to speak to the necessity of collecting this data that minority and women-owned businesses are included in the board's contracting and acquisition opportunities?
I do believe we collect that data, and we monitor that very carefully.
And why is it important?
Well, I think diversity in the workplace is an important thing, and you won't know how you're doing unless you measure it.
And just as the McKinsey Institute released in their Diversity Matters Even More report, companies that have more diverse management teams actually outperform companies that don't. That goes to the bottom line of our economy, and I wish my colleagues on the other side would stop their assault on diversity, equity, and inclusion and actually work with us to grow the economy
Gentleman's time
for
has
everyone.
expired. The gentleman from Wisconsin, Mr. Stiles, now recognized for 5 minutes.
Thank you very much, Mr. Chair. Thank you for being here, Chairman Powell. Appreciate it. You're navigating a
Guys, I'll have Arny on in the next 15 minutes. Arny will talk for 10 minutes after this is done, and then we'll be done for today. Then I'll see you guys at Market Close. So I'll have Arny on in 10 minutes. We'll discuss the new deal, and then we'll be done for today.
a difficult situation where we've had stimulative economic policies from the Biden administration, in particular, excessive government spending, investment in infrastructure, specific tax credits. At the same time, we're seeing a regulatory environment from the administration that's also restricting economic growth. We've heard a lot about the Basel III endgame, which you have a chair of. In your opening remarks, you noted that high interest rates are impacting business investment in a negative way. High interest rates are also negatively impacting the housing market. As we look at Basel III endgame, I've heard from a wide array of stakeholders, from those that are commenting on increase in bank capital standards, the negative impact that would have on the housing market, as well as from the business community, the impact that would have on their ability to invest in capital infrastructure and increase employment. Does the broad diversity of voices who hold concerns on the Basel III endgame concern you?
I would say that I've articulated concerns, and we're reading those comments, and we're very much in the process of assessing what we need to do to address them.
Thank you. I appreciate your time on that. Shifting gears slightly, as you may know, the Securities and Exchange Commission held an open meeting today to approve the final climate change rule. It's a significant regulation that I think would have a significant impact on the economy. Can you comment how the Fed thinks about the economic impact of this new regulation, or regulations more broadly, and in particular their impact on both inflation and on employment?
We don't comment on regulations of other agencies, sorry.
And you'll review that if it's put in place, or you'll review the economic impact as the empirical data comes forward?
We're not in the business of scoring, CBO does that. They'll look at this and make a careful assessment of the economic impacts and budgetary impacts and that kind of thing.
Thank you. I'll shift gears again. One of your two mandates is to maximize employment in addition to maintaining price stability. And as you know, government hiring has accounted for a large share of total job creation. More than 600,000 public sector jobs were created last year, and the federal government now employs nearly 3 million workers. So when you're examining employment data, how does the Fed view the impact of the public sector employment growth relative to private sector economic growth? In other words, how do the two data points factor into your assessment of how the broader economy is performing?
So the jobs are jobs, right? But I think we would tend to look at private sector jobs to get a better assessment. Private sector job creation is a better indicator of kind of the private sector momentum in the economy. But we look at both. They both count.
And does the dramatic increase in the private sector number of jobs give you any pause or concern as it relates to?
You mean in the public sector?
In the public sector. Sorry if I misspoke. Yes, the public sector.
The truth is the public sector was unable to hire at the beginning because wages went up a lot in the private sector at the beginning of the pandemic inflation, and public sector can't respond to that. So there's some catch-up hiring going on there now. Now that things are settling down to normal, I think there's some catch-up hiring. I'm not sure it's an issue we're concerned about.
Okay, I'll shift gears in my final minute just to talk a little bit to get your perspective on the macroeconomic developments that are having an impact on our monetary policy, specifically as we think about the potential for a productivity boom, from AI to work at home to other factors. The data is probably too early to tell whether or not we're having a true productivity view. But how does the Fed view the adoption of some of these new technologies, in particular AI, as it relates to labor productivity?
So everyone's looking at AI for that question, and it's hard to say. Actually, we've had really nice productivity in the last year or so, but it's probably still very much affected by the post-pandemic factors that we're seeing. I think we need to see more to understand whether there is a longer term boom. AI certainly has the capacity to either augment labor or to replace labor. And that's a key question. We really don't know which of the two it will do. Tons of money being invested in it, and so it's likely to drive significant productivity. I would say right now technology, but also higher labor mobility. A lot of people quitting during the really tight labor market, and also the rising startups. There were a lot of people started companies during the pandemic. Those are the kind of things that do add up to higher productivity over time. So there is hope that we'll see some productivity out of this.
Thanks for your comments today, Mr. Chair. I yield back.
Gentleman yields back. We'll go to the last questioner of the day, the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Mr. Chair, I have several questions about some of the most common complaints that I've heard about Basel III Endgame. I have an open mind on the subject, but I want to hear your response to some of the arguments that have been leveled against it. First, the Fed has repeatedly reassured the public that the banking system is well capitalized. Yet the Fed is advancing Basel III on the assumption that the banking system is undercapitalized. So the first question is, how do you reconcile the Fed's repeat assurances about a well-capitalized banking system with Basel III's assumption of an undercapitalized banking system? The second question, if the purpose of Basel III is to align US banks with their banking peers elsewhere in the world, why is the Fed imposing requirements that are more stringent than those prescribed by Basel III? In other words, why is the Fed, quote unquote, gold plating? The third question is, how do you reconcile Basel III's recommendation for standardization with Congress's statutory requirement for tailoring? Standardization would seem to be in conflict or in tension with regulatory tailoring. And the fourth and final question, do you think that Basel III could have the unintended consequence of reinforcing the trend toward shadow banking, which would mean less regulation, not more? Is there a sense in which we are transferring risk from the regulated sector of the financial system to the deregulated sector? So I bombarded you with 4 questions, and I'll give you the time you need to answer them.
Okay, so this is a good question. This is the last one. I got Arny backstage. After this question, we'll have Arny on, and we'll talk for another 10, 15 minutes about Palantir. This is actually a really good question about the regional banking crisis. NYCB is down about 30% today. It got halted, so the way he answers this is going to definitely be important. Here we go.
I'm going to have a hard time reading my handwriting here, but I'll start with yes to the fourth one. I'll give you that one because that is clearly a risk. We've seen intermediation activity moving out of the regulated system, and this has the risk of doing more of that. So what was, in a word or two, what was the one again?
Just you said, and you testified
capital, yeah.
repeat reassurances about the capitalization of the bank.
So I addressed this in my remarks in the open board meeting. Higher capital is always going to add to safety and soundness, but there's a cost.
Right.
So identifying the precise right level is very, very difficult. Hard to do it objectively. I've said for years in these rooms that I thought that the level of capital in the U.S. banking system was about right. So I posed and I voted for all these increases during Dodd-Frank. So I think it's a very fair question. We'll be looking at that. The second one was
the concern about gold plating.
About
gold plating?
Oh, gold plating. Yeah, no, it is. And I said this in my public remarks that we're exceeding the minimums with this proposal, and we also exceeded what the other big jurisdictions are doing. And so that's a question. That's a good question. I'll agree.
Okay, great.
And the third?
And the third is, I think you more or less, and standardization versus tailoring.
Standardization of, it was something.
Yeah, so Congress passed a statute requiring regulatory tailoring.
No, that's
and do you think Basel III is in compliance with that statute?
I addressed that in my comments too. I think you're right. We do need to take on board the lessons of Silicon Valley Bank as it relates to the smaller, large banks, but we don't need to throw away the tailoring that's required by the law, but also that is appropriate if we're going to have a diverse banking system.
The collapse of SVB was largely a story about liquidity risk and interest rate risk, yet the focal points of Basel III are credit risk, market rate risk, and operational risk. What is your response to the criticism that the Fed should focus its energies on addressing the forms of risk that were responsible for the SVB bank failure rather than focusing on forms of risk that were largely unrelated to it?
So I agree with that, but I would say we are working on a package of liquidity measures, which is directly which directly addresses the Silicon Valley Bank situation. We've also taken a lot of supervisory actions with other medium and small sized banks that had a lot of uninsured deposits and a lot of real estate risk and things like that. So we've been doing quite a lot on the supervisory section that it doesn't require new rules.
And then finally, as you know, the crippling cost of housing accounts for a third of inflation. One of the most powerful tools for producing and preserving affordable housing is the low-income housing tax credit, which has financed nearly 4 million units of affordable housing. The banking system accounts for 85% of LIHTC investments. And there's a concern that Basel III in its present form would diminish the availability of LIHTC and the amount of affordable housing development. And so I'm just curious, is that on your radar and is that something you're willing to examine?
Yes, it is.
So with that, I'll leave it at that. Thank you.
Gentleman yields back. That's
All right, that's it for Jay Powell. We are here. If you are on Twitter, please let me know in the chat. You can comment on the Twitter chat so we can see everyone who is here from Twitter. Thank you to everyone being here on YouTube. I have with me now backstage one of the premier analysts in the world of Palantir. Me and this guy have been covering this damn thing since it was $6. It's going to be really fun when me and Arny are we're like 40 years old and we're sitting on our jets that Palantir got us, and we're going to be remembering that at fucking $6 we were here on Twitter and YouTube yapping on about all these different contracts. Ladies and gentlemen, the man, the myth, the legend, Arny is with me here today.
Yeah, thank you for this Titanic introduction.
Arny, it's been an exciting day. Arny's Twitter is in the chat. Please make sure to follow him if you are not following him on Twitter. Okay, so stocks up 10%. Mariana upgraded us, and we got one of the biggest contracts. Not that retail is saying is one of the biggest contracts. Mariana in her note says this is one of the most consequential government contracts Palantir's ever gotten. Give me all your raw details, raw thoughts on what you think the market is reacting to when it comes to this 10% move.
It's like people are waking up. There was this big problem, I would say very big, that Palantir was born as a defense contractor, yet people were not really willing to give attention to the government side. Even when the war broke out, I actually made a trade of which I was, as an investor, proud. When Putin attacked, I had Baba, which was a position of mine, which was quite big. And as Putin attacked, essentially Baba stayed up and Palantir went down 10%. I said, okay, if there is one thing that could really help both the business and the stock is, unfortunately, a war, because Palantir is a defense contractor. And guess what happened? Nobody really cared of Palantir being a defense contractor. And this happened for essentially 2 years until now, because now we have like the officialization that Palantir belongs to not only to the defense contractor side, AI defense contractor side, but Palantir was officially a big guy between the very big guys of the industrial complex military system. And once the door is open, you have that label and you can successfully deal with one of these contracts that are huge, then you can get other big contracts like that. So as Mariana mentioned, this is not, whoa, one-off contract that adds to the revenues and that's it. This is more like the NHS deal. The contract per se is important, but the doors it opens are almost unlimited. And we know how big the defense contracts could be in the hardware side. This is a hardware contract, but it's primarily driven by AI software. So
Arny, right now we're at 2665.
Wow.
So what you're saying right now about this being a hardware contract driven by defense software, I agree with you. We're becoming like a real software prime. Do you think this is a justified move, being up 12% on this contract, or do you think the market's extending itself a little bit to Palantir?
I think there is a bit of convergence between this news, which in my opinion really requires a jump because it's like eye-opening in terms of the narrative, and it really adds contribution to the government side, which is so far the part that is lagging behind. Palantir was very strong in the government side, especially during COVID. We are now 2 years into the Ukraine war, but there was no real contribution from the government side. And this actually is set to really accelerate the trajectory. I would, and then also the AAP conference obviously is like, oh, this deal, as you mentioned in the opening, Karp really wanted that word oversubscribed to be on, because this way he knows it would create FOMO. So essentially, Palantir is inverting the dynamic it suffered from the past years, where please try our software, and now people are just, please let us in. Just
that is true. There's a divergence there. Okay, so on a day like this, Palantir is green, and another company, let's see if they flip to green. They are not green. They're down 1% on a market-ripping day. Snowflake, what are your thoughts right now, Arny? I know we talked about it on the podcast, but for those that didn't get your take on it, why do you think the market's giving the premium to Palantir right now and they're selling off Snowflake?
I believe it's essentially a matter of story. The story of Snowflake was beautiful, more beautiful than that couldn't be in the past years when Snowflake did a successful IPO, raising a lot of cash. The growth back there was very strong. The prospects of that growth to be very strong again were super fabulous. But now the story is, okay, this company has reached 2 billion and something, and the growth is expected not to be that strong any longer. The business model doesn't really scale up if you need to keep hiring so many people. Snowflake, to generate that $2.5 billion revenues, essentially like Palantir, has 7K employees, while Palantir has 4K employees, almost all engineers, while Snowflake has 3 or 4K salespeople. So essentially, Palantir is a pure software company, paradoxically, and Snowflake is a sales-driven company that just sells this product. And the story now, even with the new CEO, and is not that appealing, in my opinion. When you have a change in the guard, like it's happening with PayPal, investors are cautious. It's like, okay, you changed? Okay, let me see first how you actually manage the company. Because before trusting you again, I just need more time. And I don't think in any case, a CEO change is actually something very easy. It is already extremely difficult when you already have a person that is internal to your organization. Imagine, I don't hope this to happen, but let's say tomorrow Karp leaves the company and Sham leads the company.
If you know, you know. Go ahead. Go ahead.
That would be not such a huge shock, because essentially Sham is there since day one of the company, not day zero, but day one as the 13th employees or something like that. So essentially he's born with the company and has led the company. So nothing really new. But in this case, this new guy from Snowflake just joined last year. He's a very successful guy, but he joined the company last year. So there's this mismatch in the story. Snowflake's story was almost perfect. Investors were willing to pay a crazy multiple for that. But now this story is, I can't say really deteriorating, but it's not that appealing as it was used to be. And
Correct.
then you have Palantir, that awful story starting as a black box company that nobody could understand what it is. Then it becomes a meme. So rather than improving, actually the story starts so bad. Then it crashes. So a meme stock that also crashes. Unprofitable, untouchable. Only Cathy Wood wants that. And then even Cathy Wood dumps Palantir.
And then she bought 79. And then she bought 79,000 shares yesterday. No, that's correct. Arny, what do you think about AIPCon? So that's happening tomorrow. OpenAI, Lowe's, 8VC. They didn't announce a lot about this. They didn't build up any hype to it. And real quick before you answer, the YouTube thumbnail on OpenAI is this. The title is Compressing Space and Time. And this is the screen where we see the sky. It kind of feels like they're going to do some wild presentation around space. What are your thoughts on AIPCon 3? And do you think that could have an impact on the stock tomorrow as well?
I don't think it would have an impact directly on the stock. Maybe just after 1 or 2 days when if analysts are actually invited. Do you remember Karp in the last earnings calls essentially saying, well, analysts, if you want to join and actually see what we do, that could be a good occasion to actually understand, since you don't really want to study and try to understand what we do. So there could be a progressive switch coming from analysts. I don't expect the event per se to actually generate a shock, but I would say every information we have so far that gives us a hint that Palantir is truly getting market share, and there are successful use cases that prove Palantir is not dreaming, but actually is developing stuff that work. Have you noticed at Violin podcast is almost embarrassing how many times they talk about, if only there was LLMs that actually do actions in your business, and then Chamath saying, all these models, yes, nice chat, but at the end of the day, nobody is really doing something that is really useful. Guess what? Actually, that's a company.
Yeah, no, I agree. I 100% agree. I think it's so funny because we've been covering this thing since $6 and like the world didn't care. And then one day the world wakes up and they care because it's really working. And there was a risk at $6 when we were covering it, because what if it didn't work? But I think the due diligence you did and just like looking at the stuff, EtherSquare, a good friend of us, he found 200 links that are open for Q1. How about we end on that? What do you expect for Q1? And what do you think an Nvda moment looks like? Because the street's really going to wake up when Palantir puts up like 30% year-over-year growth. They haven't done that yet. Do you think the links we're finding connecting other companies to Foundry and the overall momentum in the commercial business might result in a monster quarter? And on top of that, Arny, do you think S&P is priced in, inclusion is priced into the price right now as well, going into the Q1?
Well, let me start first from the last one. The S&P 500 bluffed me because I was having a small trade on saying, okay, the stock, people are not really paying attention to the S&P 500 potential inclusion, apart from us retail. I didn't see any newspaper. And then, we didn't have the inclusion. So probably the call option activity that drive the stock up and then let it draw down a little bit was mainly retail driven, I guess. But the fact that we saw Supermicro Computer going up like 20% with the announcement means that in that case it was not included yet. So I don't think the S&P 500 inclusion is actually priced in. Maybe it could happen in the next 3 months if just before the announcement we see like a ramp up, but so far that is not included in my opinion. And then what were the other?
And then the links. So how do you think Q1 will look like given the customer count acceleration?
I personally think Q1 to further see some acceleration of the dynamics, like the client acquisition. In terms of pure numbers, that is something that we really need to consider on. That, we were super excited that the growth of the US commercial is 70%, which is massive, okay? But we don't have to assume this 70% to be in Q1 too, for the simple reason that this 70% is partly driven by growth, but is partly driven from a base effect from last year. Q4 of last year was actually a dip in in the revenues. So now we make a comparison with something which was relatively lower. So it's like 40% is the baseline. There was this dip in the revenue in Q4 2022.
Right.
Therefore, the year-on-year comparison is a bit overinflated. So that's why also in the guidance, they guided for more like 40% growth. But what's really important is the client acquisition, which was quite bad in the last quarters, 2 years, around 20, 30 clients. If now we are getting closer to 50 and potentially to 70 or more, that would be the hint, okay, we are really firing up. And sooner or later, that Nvidia moment could actually happen. I personally think that could happen more towards the end of the year, because in order to have that woo moment, you would really need to see acceleration in the numbers. So Nvidia is doing an Nvidia because the numbers are accelerating. And from a mathematical standpoint, in terms of financial numbers, the end of the year would be the nicest spot, because back then, and by the end of the year, the SPACs impact would be very negligible.
Yep.
While in Q1 and Q2, there would be some residual impact from the SPACs. So my personal guess is toward the end of the year, we would see more gradual acceleration. But whenever, it's like, as long as the business is performing well, they're getting customers, we know that that growth sooner or later will arrive. I would underscore one thing that I just noticed by looking at the article you shared of Mariana, the new report. Have you noticed the growth estimates Mariana has?
I'll pull it up right now. It's a little higher, correct?
Yes, and Mariana is actually way higher than other analysts in terms of revenue estimates. Look at the top right.
Okay, here you
So
go.
you see. So essentially, from this, we can see how much impact she gives to the Titan contract. And she sees this Titan contract actually to impact for just $20 million revenue additional.
Yeah. Yeah, because the Palantir guided for what, 2.65 to 2.68. So she's saying actually they're going to do 2.67 to 2.69, and that's what's justifying her price target upgrade as well.
So she sees a bit of acceleration in 2024, but then the interesting numbers are 2025 and 2026, where she sees revenue accelerating to 26%. And my gut feeling is, okay, 26% is actually neither very high, considering Palantir structurally could grow toward 30% if we look at the past historical rates and what CARP initially hinted at the DPO. And yet, that is already way better than what other analysts project. If you look at the analyst consensus estimates, yes, after the Q1 results, they increased the margins in terms of EPS, meaning that they increased the estimates for the bottom line, but not for the revenue. Analysts still estimate the revenue to keep growing at 20% in the next 3 years. So Mariana is more positive with 26%, but I have to say, if this AI wave is actually that strong, I personally believe this 26% is more a baseline rather than the target. Yet Mariana doesn't, like, she wants to show she's bullish. She doesn't want to use all the bullets already.
No, I agree, dude. S&P 500 is not priced in. The Q1 numbers can crush. Government revenue can accelerate. Now, look, we don't know. Government revenue goes up and down and up and down. And today it's really good. For the next couple months, it might be stagnating. But if Mariana thinks that this is a pivotal moment, remember Titan, I think, everyone knows it's 1.5 billion, but we're getting it in phases. And we got the first phase in June, second phase a couple months after that. Now we're on this third implementation prototype phase. And if that's the case, 178 million just for one of these phases, we're going to have 10, 15 more of these phases, 100 more of these phases over the next couple of years. Not to mention JADC2, which is going to be, the military's entire overall plan to implement AI and machine learning throughout the entire DoD. there is going to be a lot of momentum over the next couple of years, and that's just government. That's not to mention all the crazy stuff they're doing with the commercial. Right here in Mariana's note, she says, JATSI 2 is the DoD's effort to connect individual networks of services into a single network. Realizing this vision is a critical priority for the DoD and key to the U.S. maintaining an enduring advantage. 2023, Palantir showed how they could become the digital backbone. 2024, the government is starting to actually spend, and Palantir is starting to secure some of these contracts.
So we have seen already that Palantir is getting JATSI 2 contracts. Now we're getting the Titan contract. So essentially, it's like saying the DoD is admitting they rely on Palantir shoulders to renovate themselves. So as we mentioned, like with the NHS deal, these contracts are important for the size. But what is even more important is the signal these contracts give, because we don't have to think of these deals as if okay, it's like a Palantir sells 10 licenses for 1 year and that's it. No. It's like you get that deal that helps you, but meanwhile, you get the reputation now as the first software prime that allows you to enter many doors. You could potentially get huge contracts. Essentially, when you are a prime, you get the option to receive these huge contracts for which you essentially are the manager of these contracts.
Yep.
You put your name on that. And also in the international stage, if Palantir is not just a software provider that tries to fight to challenge the primes, but it is actually considered a prime, how easy it is to actually get big contracts in a similar shape like the other defense contracts around the world, ex-China, ex-Russia.
Well, I think that's what Mariana is recognizing, right? I think Mariana is like, okay, I'm raising the price target because once you get a prime contract, which only hardware manufacturers are supposed to get, like Raytheon, like Lockheed Martin, and the government finally says, no, their shit is just not good enough. We're giving it to this like silly little $50 billion software company. That is a change in tone that at least Mariana is trying to indicate is something that cannot be ignored. So that the next time the DoD needs some type of AI-enabled software, which we know over the next decade, they're going to need a lot of that stuff, no matter what president gets elected. Palantir is going to be one of the first names that gets called to do this. And that just means the government moat is only going to get stickier and bigger.
You know, you said the word ignore. And the nice stuff is in October 2022, Mariana and her boss, shared this article called Data is the New Bullet. And I wrote a kind of reply/reaction to that, writing, yes, data is the new bullet, but nobody cares. And for this reason, invasion of Ukraine, you have all the software primes going up, and you had Palantir just... Palantir was completely ignored, but only Mariana and her boss realized how Palantir was in that setting. And I had a question of how it is possible. Well, this is why, essentially, because Mariana and her boss, so Bank of America, was the only desk covering Palantir from the desk of aerospace and defense.
Wow.
While all the other analysts, so Goldman Sachs, William Blair, Jefferies, all of them are guys who only studied software companies. So what happened? Government side, they had no idea what's going on. Literally zero idea. So they never talked with defense prime contractors. They didn't know exactly what Palantir did, how valuable it was. And then on the software side, since Palantir is very diverse from the classical Snowflake for forward deployment engineers and stuff like that, they didn't, rather than understanding and appreciated what Palantir does, they were just, this thing sucks.
I agree. And now the world finally has to notice. Arny's Substack, everybody, is in the description. That article you just showed is from PalantirBoats.com. If you care about Palantir and you're not subscribed to this, it's free to subscribe. You have to subscribe to this this Substack, which is very bullish, but also objective on Palantir, PalantirBoats.com. Also his Twitter. I'm putting in the chat. If you do not follow him on Twitter, please make sure especially for the people that are watching this on Twitter, to follow him on Twitter. If you just type in Arny Palantir, he'll pop up. Anyway, Arny, this is going to be really exciting stuff. Last question I have for you, 2665. Do you think it holds, or do you think we sell off into the low 25s over the next coming days?
If I have to speculate, I think 25 could be just just there for a moment, just to see the price discovery mechanism, just to test the stress of people, like the V shape we did today. I think it was like, okay, let's test the reaction of investors if we we have a price dip.
Yeah.
And I think at this point, there is an ongoing battle on the covered calls, because when you have this spike, people are incentivized to write new covered calls.
Correct.
Because the premiums are appealing. But on the other hand, if there are these spikes, also a lot of people who already have already written the covered calls, then they start sweating because they could be called away if there is an additional 10% move. So I personally think like the long-term trajectory now is way stronger. So there will be always be these plus 10, minus 10, and so on. But the difference from now and 2 years ago was there. Now when it dips, there is actual demand.
Correct.
We just wait for increasing the ownership they have on Palantir, and
Right.
there are very strong incentives to actually have that ownership to increase. So, you know, when you have a company that is really pristine in terms of financial numbers, they enter a very good theme in terms of story. And now there are two stories: AI software in government, AI software in commercial. You are less careful of evaluation. It is more important, okay, I just want to be
let me
exposed to
rephrase that. Forget less careful. You don't give a fuck about the valuation once you get to the price. Like if it goes to 23 and you've been waiting, people don't care anymore, right? They just buy.
I mean, you see, and if you have it and it goes up a lot because there is this new flow of deals, big deals, you're more scared of missing the wave rather than a potential 10% downside.
Yep.
So there's a mentality of it is worth buying the dip because not having the dip being out could be riskier for me as a as an institutional investor. For retail investors, we are more flexible. Let's put it this way.
Right. I agree. Arny, this has been a fun journey. These are the days we look for as content creators. Thank you everybody for joining. It makes it so much more fun that there's this whole community around it. And again, it's just one of the most authentic, real communities on the internet when it comes to stocks, because we're all just so excited about this company. Alex Karp is excited to be the CEO of this company, and the company keeps executing, which gives us more room to be excited. So
I mean, imagine Karp leaving the company and now it is working. It's like, are you kidding me?
No, dude. Like, and again, this is no shade to Frank Slootman, but he was not a founder of Snowflake. Karp, I think that he had that quote a year ago where the only time he's not thinking about Palantir is when he's having sex. So outside of that, he's obsessed with Palantir, and that's the guy you want to bet on. And he's obsessed doing it his way. At $6, he did not care about the valuation or the price. He was the same level of cockiness that he is today. Literally nothing has changed. Except now, when he's cocky, everyone believes him because
remember when at Davos he said, "Yes, sometimes we are overvalued, sometimes we are undervalued, but I already know what analysts will say in 2 years. So now."
I remember that he was like, "I already know what they're going to say in 2 years because I know we're going to execute. So we're overvalued, undervalued. I don't care. We're just going to build a generational company."
I mean, Zlotman is a great manager, a great general, but is not such a leader that he's a good executor. Karp is Karp because he inspires.
Agreed.
He has a mission.
Karp is getting the whole world excited about this mission. He's got us excited about his mission. All right, folks. That's it for us. I'll be back on the market close 3:45. We still got a lot to analyze. We have earnings today as well. Arnie, thank you for joining. His Twitter and PalantirBullets.com will be in the description. Please make sure to check it out.
My
Twitter's in the
pleasure.
chat right now. And we will see you guys on Palantir Weekly. We'll have a lot to talk about this Friday, but I'll be back at 3:45 for the market close.
And be careful, there is also a Sham interview later.
Yeah, Sham interview at 4 p.m. So I'll be covering that on CNBC. So 3:45, we'll be back 15 minutes before that. And then Karp, Bloomberg just said they're going to be interviewing him tomorrow at AIPCon. So we'll see that as well.
Nice.
1 p.m. Eastern tomorrow, we'll be live. Arnie, if you're free, you can join me here live, and we'll watch AIPCon.
Yeah, sure.
All right, everybody,
And
have a good one. We'll see you in a couple hours. Bye, everyone.
Ciao, ciao.